The aggregate market value of the voting and non-voting common equity held by non-affiliates of the registrant was approximately $9,666,000 based upon the closing sale price of the company's common stock on the Nasdaq Capital Market on June 30th, 2025. As of March 10th, 2026, there were outstanding 3,406,616 shares of the registrant's common stock. SUNation Energy Inc., herein referred to as SUNation Energy, SUNE, we, or the company, is focused on growing leading local and regional solar, storage, and energy services companies nationwide. The SUNation Energy vision is the provision of exemplary client service while powering the energy transition through grassroots, community-centric growth of solar electricity paired with battery storage. Our portfolio of brands, SUNation, Hawaii Energy Connection, e-Gear, provide homeowners and businesses of all sizes with an end-to-end product offering spanning solar, battery storage, and grid services. SUNation Energy Inc.'s markets are New York and Hawaii, and the company operates proudly within 2 U.S. states. Our primary customers are residential homeowners. We also provide solar energy systems to commercial owners and other municipal customers. SUNation Energy is a Delaware corporation originally organized in 1969 that operates directly and through its subsidiaries located in the United States, U.S. SUNation Energy's vision is to power the energy transition through grassroots growth of solar electricity paired with battery storage. The company is a domestic operator and consolidator of residential solar, battery storage, and grid services solutions. Our strategy is focused on acquiring, integrating, and growing leading local and regional solar, storage, and energy services companies nationwide. Our current business units, Hawaii Energy Connection, LLC, and New York-based subsidiaries, the SUNation entities, collectively SUNation New York, are engaged in the design, installation, and maintenance of solar energy systems across residential, commercial, and municipal sectors. Our team specializes in providing tailored solar solutions that meet the specific energy needs of each client, ensuring both efficiency and sustainability. In addition to our core solar services, we also offer energy storage systems to optimize energy use and increase reliability. Our New York business unit further integrates a broader range of services, including residential roofing solutions, to ensure seamless solar installations and long-term durability. Additionally, we provide community solar services that allow groups of individuals, businesses, or organizations to share the benefits of a single solar array, making renewable energy accessible to more people in the community. Our strategy is designed to provide customers with sustainable energy security by leveraging our people, technology, and processes to deliver solutions that improve the performance, increase the reliability, and reduce the cost of energy. Key elements of our strategy include capitalizing on the opportunity for industry and regional consolidation. Residential solar is a fragmented industry with over 4,000 contractors nationwide. We believe the Tesla Solar City acquisition in 2016 and the Sunrun Vivint merger in 2020 started an era of consolidation and the positive impact of scale expansion. According to Wood Mackenzie, as of 2025 Q4, 75% plus of the residential solar market is served by a regional or local installer. We believe there is a tremendous opportunity for a consolidator to rapidly scale its business and become one of the most recognized brands in the industry through acquiring, integrating, and growing leading local and regional solar sales and installation companies. Marketirize and continue to lower our customer acquisition costs through referral programs. We already have what we believe are premier referral rates, with approximately 35% of installed jobs in 2025 coming from referrals or repeat customers. We believe that our existing HEC and SUNation NY portfolio companies form a foundation to drive improved referral performance across the network of companies we acquire, further increasing our referral rates and lowering our overall customer acquisition cost. Continue to grow our operations to achieve economies of scale. Residential and commercial solar is like many industries in that cost of goods sold is a significant expense, and companies with greater scale can enjoy significantly lower costs throughout their equipment supply chain. As we grow both organically and through acquisitions, We expect to lower the costs of acquiring key input products, such as modules, inverters, and electrical balance of systems components, which we anticipate should allow us to accelerate growth through lower pricing and enhanced profit margins. With scalable shared services, e.g., accounting, HR, policy, marketing, legal, IT, we believe our current approach of organic growth, enhanced by acquisitions, will drive profitability and cash generation. We are also able to help our customers access various options to finance their acquisition of a solar system through referrals to a variety of solar finance companies. Explore potential opportunities outside of solar to become a one-stop shop for consumers' home and energy needs. As we continue to grow our customer base, we may have new opportunities for incremental revenue generation by cross-selling ancillary market products such as more energy storage and service contracts on orphaned systems. Customers whose original solar contractor is no longer in business or have simply abandoned the local markets. We believe that the following key strengths of our business position us to execute on our M&A roll-up strategy and to distinguish us from competitors. Customer-centric approach in market, leading to competitive customer acquisition costs. SUNation Energy seeks to put the customer above all else. Our installers complete offerings in-house as full-service installers to have total control of the customer experience. Our company offers transparent, clear sales agreements and has invested in digital tools to support customers along the installation journey. Our installers are active in their local communities to build a trusted brand. These activities lead to satisfied customers, as demonstrated by a high average referral rate and favorable online reviews, helping to lower future customer acquisition costs. A leading vendor for cutting-edge product offerings. We are a leading vendor for cutting-edge product offerings from Enphase, Tesla, Franklin WH, and other large solar product providers. As an experienced operator in the residential and commercial solar industries, we have built relationships with these large solar product providers. In 2026, we will be expanding this product offering to include the Generac full home ecosystem, which includes their new power electronics, whole home batteries, standby generators, and smart thermostat that control the entire system. Seasoned and experienced management team. We have a strong leadership team with deep experience in residential and commercial solar and M&A. Our chief executive officer grew our New York business into the third largest solar provider in one of the most dynamic markets in the country. Our chief operating officer and chief financial officer is a seasoned leader in the M&A, finance, technology, and solar markets. We have over 100 years of solar industry experience at the management level. Our products and services. The primary product we offer to customers is a photovoltaic solar energy system, which is almost always installed on the roof, although can at times be ground-mounted. Solar panels, also called modules, generate direct current electricity when they are struck by sunlight. This direct current, DC, is sent to an inverter, which converts the DC electricity into alternating current, AC electricity, which is the type of electricity that is needed to provide power to outlets and run home appliances and equipment. The AC flows from the inverter to the home's main electrical panel, where it is then used to supply the home, business, or institution's current power needs. If there is a shortfall, the home draws the remainder needed from the traditional utility connection, often referred to as the grid. If the home system has excess production, the surplus is usually exported back to the grid. Residential solar systems typically provide cost savings to customers because the system's roof panels generate power from the sun instead of customers needing to purchase power from the utility. In addition, customers generally receive tax incentives and credits for the excess generation provided back to the utility. Battery storage is an increasingly important piece of our offering. Lithium-ion batteries store excess solar-generated electricity on the residential premises, as opposed to sending it back to the grid. This can generate economic benefits in markets with utility time of use (TOU) rates, whereby a homeowner is compensated at a low rate during the day for sending solar to the grid, but would be charged a high rate in the evening for drawing electricity from the grid. In TOU markets, customers can store their excess power during the day and then utilize the stored power at night, thus saving money. An equally important benefit of pairing a battery with solar is that a battery will keep powering a customer's home during a grid outage. A solar system alone will not continue providing a home with electricity if the grid is down, as the utility company establishes automatic disconnects to ensure that no live current is sent back into the grid for safety reasons. When a battery is added, the system can automatically and nearly instantaneously become a self-contained microgrid during an outage. The home can continue utilizing the electricity generated by the panels, as well as electricity stored in the battery when the sun is not shining. In addition, the excess production from the panels during the day can be used to recharge a battery that was depleted overnight. In the Hawaiian market, we also offer energy management control devices on solar systems that are paired with batteries that help homeowners generate ongoing revenue streams by aggregating their batteries into a fleet, thus creating a virtual power plant and selling grid services to the utility. We have proprietary technology in this area and strong relationships with regulators and utilities. The majority of SUNation Energy's revenue, 85% of 2025 consolidated revenue, comes from photovoltaic solar energy systems and batteries for residential homeowners. The size of our residential installations vary by location. In 2025, the average system size installed was 6.8 kilowatts for HEC customers in Hawaii and 127 kilowatts for SUNation New York's regional customers on Long Island, New York. Historically, most residential homeowners have chosen to own their home system rather than pursue a third-party ownership model. The company believes that it has historically been best for customers to own their own systems, but recognizes that some customers do not want to own their systems. For customers pursuing the home ownership model, these customers typically pursue loan financing, although a small proportion pay in cash. The company assists customers in obtaining loan financing options through our relationships with diverse funding sources. Under these loan financing agreements, there is typically no down payment or upfront cost to the homeowner. Customers will pay for this amount financed, plus a finance charge, through a monthly payment to a financing supplier. Under the customer loan scenario, we receive cash payments from the loan company upon completion of various milestones during the installation process. In addition to our residential offerings, the company has a distinct roofing business within the New York market. This division offers vertically integrated roofing services alongside our solar and storage options. Thanks to this distinction, our roofing services allow for the diversification of our product offerings, offering our regional business the chance for additional revenue opportunities. To showcase workmanship and the company's commitment to quality, the company has worked alongside General Aniline and Film, GAF, a respected industry leader in the roofing field, to climb up their partnership ranks. Since launch, the company has reached the upper echelon of GAF installer status tiers and is being recognized for its quality work in the field. SUNation Energy, through its regional business entities, actively develops and installs photovoltaic PV arrays and other renewable energy solutions for commercial, industrial, and institutional facilities across both the New York and Hawaii markets. Projects span a wide range of property types, including office buildings, warehouses, schools, and nonprofit organizations, and are tailored to meet customer needs through various system configurations, including rooftop installations, ground-mounted arrays, and solar carports. The nature of the commercial business is highly complex and has a significantly different timeline, permitting process, and labor standards as compared to solar development and deployment in the residential spaces. As a result of these complex nuances, the company has a seasoned commercial leadership team that oversees a dedicated department whose sole focus is on operations, installation, project management, and development of commercial, institutional, and industrial sites. In addition to the development of commercial projects, the company has worked with stakeholders in the private and public sectors to offer community solar, which distributes the benefits of renewable energy that is produced on larger sites to ratepayers who have opted in at a competitively priced market rate, as well as shaping policy actions across the local, state, and federal governments that are favorable towards the mass adoption of green energy. SUNation Energy, through its regional businesses, also offers service, repair, and preventative maintenance of solar systems, batteries, and other related components. Within the industry, these service operations are a unique differentiator that sets the company apart from its peers, as most solar operators in the company's key markets do not seek to maintain and/or monitor the performance of existing systems for their customers and/or non-customers. The company actively services and repairs the systems of competitor systems, as is technically feasible based on component type, age, and staff qualifications and training. With over 20 years in business, the company has found that as other solar providers have exited the market or have gone out of business, there has been ample consumer demand for these types of services, and these operations offer enhanced and diversified revenue opportunities. Roofing is a natural extension of SUNation Energy's photovoltaic offerings. While the market within the Northeast is competitive, SUNation Energy's solar and service operations allow nearly unprecedented access to homeowners in need of roofing solutions. Over the years, the company has invested heavily in the hiring of talented roof installers and deepening relationships with industry leaders in the roofing space, such as GAF, the largest roofing and waterproofing manufacturer in North America. SUNation New York is currently a GAF Master Elite Installer and been recognized in GAF's President's Club Awards. In the solar installation market, we compete with companies that offer products like ours. Some of these companies have greater financial resources, operational experience, and technical capabilities than we do. When bidding for solar installation projects, however, our current experience suggests that there is no clear dominant or preferred competitor in the markets in which we compete. We do not believe that any competitor has more than 25% of market share in the regions in which we operate. We compete with other solar installers on pricing, service, warranty, and the ability to arrange financing. We also compete on a cost basis with traditional utilities that supply electricity to our potential customers and with companies that are not regulated like traditional utilities but that have access to the traditional utility electricity transmission and distribution infrastructure pursuant to state and local pro-competitive and consumer choice policies. Our advantage over traditional utilities is that we offer customers the opportunity to create their own electricity and reduce dependency on the traditional electrical grid. We compete with these traditional utilities primarily based on price, cents per kilowatt hour, predictability of future prices, the backup power capabilities of our battery storage solution, and the ease by which customers can switch to electricity generated by our solar energy systems. We believe we are a strong competitor, but the marketplace is comprised of many companies. There are over 4,000 residential solar sales and installation companies in the U.S., and most residential solar sales are competitive with customers receiving quotes from multiple companies. We also compete with companies that are not regulated like traditional utilities, but that have access to the traditional utility electricity transmission and distribution infrastructure pursuant to state and local pro-competitive and consumer choice policies, and solar companies with business models that are like ours. Some customers might choose to subscribe to a community solar project or renewable subscriber program with these companies or their utilities instead of installing a solar energy system on their home, which could affect our sales. Additionally, some utilities offer generation portfolios that are increasingly renewable in nature. We believe that we compete favorably with these companies based on our unique multi-channel approach and differentiated customer experience. We also face competition from purely sales organizations that acquire customers and then subcontract out the installation of solar energy systems, from those installation businesses that seek financing from external parties, from large construction companies and utilities, and from sophisticated electrical and roofing companies. Within the competitive New York market, SUNation NY ranked first among solar contractors in total installed solar energy in the region in 2025, as per publicly available utility interconnection data. In addition, utility interconnection data shows that SUNation NY's aggregate installed capacity on Long Island increased approximately 29% year over year in 2025, highlighting continued growth in system deployments and reinforcing the company's position within one of the most active solar markets in the Northeast. We hold registered trademarks for, among others, SUNation, SUNation Energy, Hawaii Energy Connection, SUNation Solar Systems Inc., Sungevity, and Horizon Solar Power. These trademarks are important to our regional branding and growth strategy. We are not regulated as a public utility in the U.S. under applicable national, state, or other local regulatory regimes where we conduct business. To install systems, we obtain interconnection permission from the applicable local primary electric utility. Depending on the size of the solar energy system and local law requirements, interconnection permission is provided by the local utility directly to us and/or our customers. In almost all cases, interconnection permissions are issued based on a standard process that has been pre-approved by the local Public Utility Commission or other regulatory body with jurisdiction over net metering policies. As such, no additional regulatory approvals are required once interconnection permission is given. Our operations are subject to stringent and complex federal, state, and local laws, including regulations governing the occupational health and safety of our employees and wage regulations. For example, we are subject to the requirements of the Federal Occupational Safety and Health Act, as amended, OSHA, the U.S. Department of Transportation, ODOT, and comparable state laws that protect and regulate employee health and safety. We endeavor to maintain compliance with applicable DOT, OSHA, and other comparable government regulations. Federal, state, and local government bodies provide incentives, including rebates, tax credits, and other financial incentives, to catalyze customer acceptance of solar energy as an alternative to utility-provided power. Some of the most significant federal incentives have been sourced from the Inflation Reduction Act of 2022, IRA. Among other provisions, the IRA extended the investment tax credit, ITC, for homeowners. Qualifying homeowners who purchase a residential solar energy system and/or energy storage system can receive a 30% tax credit, returning a material portion of purchase price to homeowners. On July 4, 2025, the President signed H.R. 1, the One Big Beautiful Bill Act, or OBBBA, into law, which accelerates the phase-outs and terminations of various eligible tax credits enacted as part of the Inflation Reduction Act and places restrictions on continued receipt of tax credits by specified foreign entities and foreign-influenced entities. The OBBBA terminates several consumer-facing tax credits, including the Residential Clean Energy Credit, Section 25D, and the Energy Efficient Home Improvement Credit, Section 25C, effective at the end of 2025. The Section 25D credit previously allowed homeowners to claim a 30% credit for installing rooftop solar panels and related equipment. The OBBBA also has an accelerated phase-out of the Clean Electricity Investment Tax Credit, Section 48E, and the Clean Electricity Production Tax Credit, 45Y. In this accelerated phase-out, projects must begin construction by July 4, 2026, or be placed in service by December 31, 2027, to qualify for these credits. At the state and local level, one of the key policies in place in many states that have enabled the growth of distributed solar is net metering. Net metering provides significant value to certain customers with solar energy systems for the electricity generated by their systems, but not directly consumed on site. Net metering allows a customer to pay the local electric utility only for power usage net of excess production from the customer's solar energy system. Customers receive a credit for the energy an interconnected solar energy system generates in excess of that needed by the home or business, which is provided to the electrical grid. More than half of the states and many local jurisdictions have established property tax incentives for renewable energy systems that include exemptions, exclusions, abatements, and credits. Approximately 30 states and the District of Columbia have adopted a renewable portfolio standard, and 8 other states have some voluntary goal that requires regulated utilities to procure a specified percentage of total electricity delivered in the state from eligible renewable energy sources, such as solar energy systems, by a specified date. As of March 1, 2026, the company employed 164 people. We consider our relations with our employees to be good. None of our employees are currently represented by a labor union. The company has an information security program designed to identify, mitigate, respond to, and manage reasonably foreseeable cybersecurity risks and threats. The program is overseen by the Chief Financial Officer. The CFO, in conjunction with senior management, conducts periodic reviews of cybersecurity control, policies, and procedures to ensure relevance and effectiveness for the company's needs and operating environment. The CFO has previously led IT programs in his past work experiences and is able to apply those experiences to the company. The Audit and Finance Committee of the Board has discussions with management on an annual basis about the company's risk assessment and risk management policies, particularly in the areas of financial reporting, internal controls, and compliance with legal and regulatory requirements. One aspect of the company's information security program is focused on vendor selection. The company evaluates all third-party vendors and service providers for their cybersecurity features and compliance with security requirements. Selected vendors, for example, must employ a variety of security measures to protect against unauthorized access, data breaches, and data loss. The company remains committed to maintaining the highest standards of data security and ensuring the integrity and confidentiality of our data. Our business strategy, results of operations, and financial condition have not been materially affected by risks from cybersecurity threats, including as a result of previously identified cybersecurity incidents, but we cannot provide assurance that they will not be materially affected in the future by such risks or any future material incidents. For more information on our cybersecurity-related risks, see Item 1A, Risk Factors, of this annual report on Form 10-K. The company leases 10,000 square feet of office and warehouse space in Aiea, Hawaii. SUNation New York leases 20,000 square feet of office and warehouse space in Ronkonkoma, New York. The company believes these facilities will be adequate to accommodate its needs for the foreseeable future. We are involved in various claims arising in the ordinary course of business, including some which we believe are immaterial or which we believe to be frivolous, including actions with respect to contractual matters. In connection with these matters, we assess on a regular basis the probability and range of possible loss based on the developments in these matters. In early 2025, an action by a landlord was brought to recover approximately $34,000 plus attorney's fees and punitive damages based upon an alleged breach of the lease between Remington Industrial Management, LLC, and SUNation Solar Systems, Inc. The landlord asserts that SUNation Solar Systems, Inc. has the obligation to insure the entire building rather than keep in full force and effect fire and hazard insurance for the full replacement value of all improvements located on the demised premise, as specifically provided in the lease rider. SUNation Solar Systems denies that it has an obligation to insure the entire building under the express terms of the lease, which is not a triple net lease. The landlord had asserted 3 causes of action for breach of contract, declaratory judgment that the lease requires SUNation Solar Systems to insure the building itself, and a third vague fraud theory. The claims against SUNation Energy Inc., based upon vague allegations of fraud, are likely unsustainable. We have since come to agreement with the landlord on this matter, and a stipulation of discontinuance with prejudice has been filed with the court. As a result, the action has been dismissed. From time to time, we also face threatened legal actions or claims in the ordinary course of our business. One such matter involved a residential customer who has informally alleged that our subsidiary, SUNation Solar Systems, was responsible for the cost to replace certain equipment by a third-party manufacturer that was found to be admittedly defective by the manufacturer, the cost of which may be substantial. We have since come to agreement with this residential customer in this matter, and as a result, no litigation or threatened claims relating to this matter remain, and no formal action was filed. At March 1, 2026, there were approximately 82 registered holders of record of SUNation Energy Inc. common stock. Our current business units, Hawaii Energy Connection, LLC, AEC, and New York-based subsidiaries, the SUNation entities, collectively SUNation NY, are engaged in the design, installation, and maintenance of solar energy systems across residential, commercial, and municipal sectors. Our team specializes in providing tailored solar solutions that meet the specific energy needs of each client, ensuring both efficiency and sustainability. In addition to our core solar services, we also offer energy storage systems to optimize energy use and increase reliability. Our New York business unit further integrates a broader range of services, including residential roofing solutions, to ensure seamless solar installations and long-term durability. Additionally, we provide community solar services that allow groups of individuals, businesses, or organizations to share the benefits of a single solar array, making renewable energy accessible to more people in the community. On January 3, 2024, the company's shareholders approved a reverse stock split of the company's common stock at a ratio within a range of 1-for-2 and 1-for-15, and granted the company's board of directors the discretion to determine the timing and ratio of the split within such range. On May 28, 2024, the company's board of directors determined to effect the reverse stock split of the common stock at a 1-for-15 ratio, the June reverse stock split, and approved an amendment, June Reverse Stock Split Amendment, to the Fourth Amended and Restated Articles of Incorporation of the company to effect the June Reverse Stock Split. Effective June 12, 2024, the company amended its Fourth Amended and Restated Articles of Incorporation to implement the June reverse stock split. The company's common stock began trading on a split-adjusted basis when the market opened on June 12, 2024, the June effective date. As a result of the June reverse stock split on the June effective date, every 15 shares of common stock then issued and outstanding automatically were combined into one share of common stock, with no change in par value per share. No fractional shares were outstanding following the June reverse stock split, and any fractional shares that would have resulted from the June reverse stock split were settled in cash. The number of shares of common stock outstanding was reduced from 108,546,773 to 7,235,731, with 720.901 fractional shares paid out in cash, totaling $1,132. The total number of shares authorized for issuance was reduced to 7,500,000 in proportion to the June reverse stock split ratio. On July 19, 2024, the company's shareholders approved a reverse stock split of the company's common stock at a ratio within a range of 1-for-2 and 1-for-200, and granted the company's board of directors the discretion to determine the timing and ratio of the split within such range. Additionally, the shareholders also approved an increase in authorized shares to 133,333,333 shares. On October 1, 2024, the company's board of directors determined to effect the reverse stock split of the common stock at a 1-for-50 ratio, the October reverse stock split, and approved an amendment, October reverse stock split amendment, to the Fourth Amended and Restated Articles of Incorporation of the company to effect the October reverse stock split. Effective October 17, 2024, the company amended its Fourth Amended and Restated Articles of Incorporation to implement the October reverse stock split. The company's common stock began trading on a split-adjusted basis when the market opened on October 17, 2024, the October effective date. As a result of the October reverse stock split on the October effective date, every 50 shares of common stock then issued and outstanding automatically were combined into one share of common stock, with no change in par value per share. No fractional shares were outstanding following the reverse stock split, and any fractional shares that would have resulted from the October reverse stock split were settled in cash. The number of shares of common stock outstanding was reduced from 67,260,696 to 1,344,841, with 372.92 fractional shares payable in cash, totaling $1,891. The total number of shares authorized for issuance was reduced from 133,333 to 2,666,667 in proportion to the October reverse stock split ratio. On April 3, 2025, the company's shareholders approved a reverse stock split of the company's common stock at a ratio within a range of 1-for-2 and 1-for-200, and granted the company's board of directors the discretion to determine the timing and ratio of the split within such range. Additionally, the shareholders also approved an increase in authorized shares to 1 billion shares. On April 9, 2025, the company's board of directors determined to effect the reverse stock split of the common stock at a 1-for-200 ratio, the April reverse stock split, and approved an amendment, April reverse stock split amendment, to its certificate of incorporation to effect the April reverse stock split. On April 16, 2025, the company amended its certificate of incorporation to implement the April reverse stock split. The company's common stock began trading on a split-adjusted basis when the market opened on April 21, 2025, the April effective date. As a result of the April reverse stock split on the April effective date, every 200 shares of common stock then issued and outstanding automatically were combined into one share of common stock, with no change in par value per share. No fractional shares were outstanding following the April reverse stock split, and any fractional shares that would have resulted from the April reverse stock split were rounded up to the nearest whole share. The number of shares of common stock outstanding was reduced from 672,799,910 to 3,406,614. The effects of the June 2024 reverse stock split, October 2024 reverse stock split, and April 2025 reverse stock split collectively known as the reverse stock splits, have been applied retroactively and are reflected in this annual report on Form 10-K for all periods presented. Following each of the reverse stock splits, the number of shares of common stock available for issuance under the company's equity compensation plans were automatically reduced in proportion to the reverse stock splits ratio. Upon effectiveness, the reverse stock splits also resulted in reductions in the number of shares of common stock issuable upon exercise or vesting of equity awards in proportion to the reverse stock splits ratios, and caused a proportionate increase in exercise price or share-based performance criteria, if any, applicable to such awards. The discussion and analysis of our financial condition and results of operations are based upon our financial statements, which have been prepared in accordance with generally accepted accounting principles in the United States, GAAP. The preparation of these financial statements requires us to make estimates and judgments that affect the reported amounts of assets and liabilities and disclosure of contingent assets and liabilities at the date of the financial statements and the reported amount of revenues and expenses during the reporting period. Generally, we base our estimates on historical experience and on various other assumptions in accordance with GAAP that we believe to be reasonable under the circumstances. Actual results may differ from these estimates, and such differences could be material to our financial position and results of operations. Critical accounting estimates are those that involve a significant level of estimation uncertainty and have had or are reasonably likely to have a material impact on our financial condition and results of operations. While our significant accounting policies are more fully described in Note 2, Summary of Significant Accounting Policies, to the consolidated financial statements included elsewhere in this report, we believe the following discussion addresses our most critical accounting estimates, which involve significant subjectivity and judgment, and changes to such estimates or assumptions could have a material impact on our financial condition or operating results. Therefore, we consider an understanding of the variability and judgment required in making these estimates and assumptions to be critical in fully understanding and evaluating our reported financial results. Goodwill. Goodwill is recorded as the difference, if any, between the aggregate consideration paid for an acquisition and the fair value of the assets acquired and liabilities assumed from acquisitions. We test goodwill for impairment annually on October 1st, or more frequently if events and circumstances warrant. Such events and circumstances may be a significant change in our business climate, economic and industry trends, legal factors, negative operating performance indicators, significant competition, or changes in strategy. We perform our goodwill impairment test at the reporting unit level, which is the same as our operating segments. An impairment charge for goodwill is recognized only when the estimated fair value of a reporting unit, including goodwill, is less than its carrying amount. In applying the goodwill impairment assessment, the company may assess qualitative factors to determine whether it is more likely than not that the fair value of the reporting unit is less than its carrying value. Qualitative factors may include, but are not limited to, economic, market, and industry conditions, cost factors, and overall financial performance of the reporting unit. If after assessing these qualitative factors, the company determines it is more likely than not that the fair value is less than the carrying value, a quantitative assessment of goodwill is required. The quantitative impairment test requires judgment, including the identification of reporting units, the assignment of assets, liabilities, and goodwill to reporting units, and the determination of fair value of each reporting unit. The impairment test requires the comparison of the fair value of each reporting unit with its carrying amount, including goodwill. We estimate the reporting unit's fair value using a combination of the income approach based upon projected discounted cash flows of the reporting unit and the market approach based upon the market multiple of comparable publicly traded companies. If the estimated fair value of the reporting entity exceeds the carrying value, the goodwill is not impaired and no further review is required. However, if the carrying value exceeds the estimated fair value of the reporting unit, an impairment expense should be recognized for the excess of the carrying value over the fair value. Under the income approach, the estimated discounted cash flows are based on the best information available to us at the time, including supportable assumptions and projections we believe are reasonable. Our discounted cash flow estimates use discount rates that correspond to a weighted average cost of capital consistent with a market participant view. Certain other key assumptions utilized, including revenue and cash flow projections, are based on estimates consistent with those utilized in our annual budgeting and planning process that we believe are reasonable. However, if we do not achieve the results reflected in the assumptions and estimates, our goodwill impairment evaluations could be adversely affected, and we may impair a portion or all of our goodwill, which would adversely affect our operating results in the period of impairment. The market approach identifies the revenue multiples of comparable publicly traded companies. The reporting unit's revenue projections are multiplied by the market multiple to estimate its current estimated fair value. If the market multiples or revenue value assumptions are incorrect, our goodwill impairment evaluation could also be adversely affected, and we may impair a portion or all of our goodwill, which would adversely affect our operating results in the period of impairment. During the third quarter of 2025, as a result of a material decline forecasted revenues and operating results due to the implications of the OBBBA, we performed an interim quantitative analysis as of September 30th, 2025. Based on the results of this analysis, we concluded that there was no impairment indication within our HEC and SUNation NY reporting units between the fair value and carrying value of the reporting units. During the fourth quarter of 2024, as a result of a material decline in our stock price and forecasted revenues and operating results, we performed an interim quantitative analysis as of December 33, 2024. Based on the results of this analysis, we concluded that the fair value of our HEC reporting unit did not exceed its carrying value as of December 33, 2024, and recorded an impairment loss of $3.1 million in our consolidated statements of operations, reducing our HEC goodwill balance to $6.7 million and our consolidated goodwill balance to $17.4 million. There was no impairment indication within our SUNation NY reporting unit. Recoverability of long-lived assets and intangible assets. The company reviews its long-lived assets and definite-lived intangible assets for impairment whenever events or changes in circumstances indicate that the carrying amounts of the assets may not be fully recoverable. If indicators of impairment exist, management identifies the asset group that includes the potentially impaired long-lived asset at the lowest level at which there are separate, identifiable cash flows. If the fair value for the asset is less than the carrying amount of the asset, a loss is recognized for the difference between the fair value and carrying amount of the asset. During the third quarter of 2025, as a result of the OBBBA, the company performed an impairment test on the trade names and trademarks intangible assets associated with both the HEC and SUNation New York reporting units as of September 30th, 2025. The company performed the analysis under ASC 360, and no impairment charge was realized. Consolidated sales increased 26% to $71,905,527 in 2025 from $56,861,753 in 2024, with a 31% increase within residential contract revenue and a 19% increase in service revenue, partially offset by a 1% decrease in commercial revenue. On a consolidated basis, overall kilowatts installed on residential projects increased 31%, and revenue per residential installation increased 31% in 2025 as compared to 2024. The overall increase in residential revenue is driven by increased customer demand to install solar systems prior to the expiration of federal tax credits at December 31, 2025, under the passing of the One Big Beautiful Bill Act. Consolidated gross profit increased 35% to $27,544, $213 in 2025, as compared to gross profit of $20,426,244 in 2024, due primarily to the increase in revenue and improvement in residential margins. Gross margin increased to 38.3% in 2025, compared to 35.9% in 2024. Consolidated operating expenses decreased 10.8% to $29,217,250 in 2025, as compared to $32,743,647 in 2024. Consolidated selling, general, and administrative expenses decreased 0.3% to $26,979,750 in 2025, from $27,000 to $54,166 in 2024, due primarily to a decrease in corporate selling, general, and administrative costs, partially offset by increases at HEC and SUNation New York. Corporate general and administrative expenses decreased 17.7%, or $1,281,827 to $5,976,017, due primarily to $1,300,000 in expense in the prior year on loss contingencies related to certain prior securities issuances. Amortization expense decreased by $600,000 to $2,237,500 in 2025 due to the write-down of the technology intangible asset at HEC at December 31, 2024, resulting in lower amortization expense in the current year. There was a $1 million decrease in a fair value remeasurement gain related to the SUNation New York acquisition earnout consideration in 2025 as compared to 2024. The company also recorded a $3,101,981 goodwill impairment loss within the HEC segment and a $750,000 intangible asset impairment loss during 2024 related to technology-related intangible assets within the HEC segment. Consolidated other expense increased $5,671,073 to expense of $9,168,656 in 2025 as compared to income of $3,497,583 in 2024. The increase was primarily related to a $6,556,221 increase in the fair value remeasurement loss on the warrant liability, $1,294,090 in financing fees, primarily on the issuance of the contingent forward contract and issuance of Series A and Series B warrants, a $486,178 decrease in fair value remeasurement gain on the contingent value rights, CVRs, and a $307,814 increase in loss on debt extinguishment, partially offset by a $65,617 decrease in fair value remeasurement loss on the embedded derivative liability, a $899,080 increase in fair value remeasurement gain on the contingent forward contract, and a $2,045,615 decrease in interest expense. Consolidated operating loss before income taxes in 2025 was $10,841,693, compared to a consolidated operating loss before income taxes of $15,814,986 in 2024. Net loss in 2025 was $10,892,833, or $4.38 per diluted share. Net loss attributable to shareholders in 2024, after taking into effect $11,587,121 in deemed dividends, was $27,436,926, or $10,110.93 per diluted share from continuing operations. Residential contract sales increased $9,500,242, or 31%, due to a 25% increase in systems installed and a 40% increase in kilowatts installed. The overall increase in residential revenue is driven by increased customer demand to install solar systems prior to the expiration of federal tax credits at December 31, 2025, under the passing of the One Big Beautiful Bill Act. Commercial contract sales increased $194,454, or 3%, due primarily to the timing of commercial projects. Gross profit increased 34% to $20,166,363 in 2025 as compared to gross profit of $15,093,667 in 2024, due primarily to the increase in revenue and additional increase in gross margin. Gross margin increased to 40.7% in 2025 compared to 38.0% in 2024, due primarily to revenue mix with higher margin residential revenue making a larger percentage of the total revenue in 2025 as compared to 2024. The higher residential margins are driven by lower material costs as a percentage of sales. Selling, general, and administrative expenses increased 6% to $16,337,256 in 2025, 33% as a percentage of sales, as compared to $15,265,443 in 2024, 38% as a percentage of sales, due primarily to an increase in selling and marketing expenses on higher residential contract revenue, partially offset by a decrease in personnel costs on lower headcount. Amortization expense remained flat at $812,500 in 2025 as compared to 2024. Residential contract sales increased $5,009,362, or 31%, despite a 2% decrease in systems installed, due to a 9% increase in kilowatts installed, a 66% increase in battery capacity installed, and a 20% increase in price per watt installed. In the first half of 2024, the battery bonus program in Hawaii ended. Battery installations decreased when this incentive went away. In May 2025, Hawaii implemented a new BYOD Plus program. The impact of this new program was realized in third-quarter installations. Under this program, customers were paid a cash incentive and provided energy bill credits to add energy storage to an existing or new rooftop solar system. Commercial contract sales decreased 239,565, or 56%, due to timing of projects. HEC has limited commercial projects, and the revenue from this revenue stream can fluctuate year over year. Service revenue increased $407,028, or 57%, due to an increase in repair and replacement installations. Gross profit increased 38% to $7,377,850 in 2025 as compared to gross profit of $5,332,577 in 2024, due primarily to the increase in revenue and improvement in gross margins. Gross margin increased slightly to 33.1% in 2025 compared to 31.1% in 2024, due primarily to a decrease in material and labor costs as a percentage of revenue. Selling, general, and administrative expenses increased 5% to $4,766,476 in 2025, 21% as a percentage of sales, as compared to $4,530,879 in 2024, 26% as a percentage of sales, due primarily to an increase in commissions expense and gross excise taxes on higher revenue. Liquidity and capital resources. As of December 31, 2025, the company had approximately $7,182,344 in cash, restricted cash, and cash equivalents, and liquid investments, compared to $1,151,348 at December 31, 2024. Of this amount, $665,582 was invested in short-term money market funds that are not considered to be bank deposits and are not insured or guaranteed by the Federal Deposit Insurance Corporation or other government agency. These money market funds seek to preserve the value of the investment at $1 per share. However, it is possible to lose money investing in these funds. The remainder in cash and cash equivalents is operating cash. The company had working capital of $1,066,408, consisting of current assets of approximately $16,473,979 and current liabilities of $15,407,571 at December 31, 2025, compared to a working capital deficit of $16,051,658, consisting of current assets of $11,110,385 and current liabilities of $27,162,043 at December 31, 2024. Cash flow provided by operating activities was approximately $954,978 in 2025, compared to $6,302,686 used in operating activities in 2024. The positive cash flow from operations is primarily driven by the decrease in the company's operating loss and the decrease in interest expense. Significant working capital changes in 2025 included a $575,858 decrease in accounts receivable, $1,720,872 increase in accrued compensation and benefits related to the earnout liability, as discussed further in Note 8, commitments and contingencies, and a $635,556 decrease in accrued interest. Cash used in investing activities was $48,594 in 2025, compared to $26,667 used in 2024, primarily related to capital expenditures. Net cash provided by financing activities was $5,124,612 in 2025, compared to $2,084,358 provided in 2024. Net cash provided by financing activities in 2025 was due to $17,871,964 in net proceeds from the issuance of common stock under a registered direct offering and $351,372 in proceeds from the issuance of common stock under the at-the-market offering, partially offset by $10,081,464 in payments against loans payable, $2,500,000 in payments of contingent consideration, $267,391 in payments for the termination of warrants, and $276,000 in CVR distributions. Net cash provided by financing activities in 2024 was due to $1 million in proceeds from the issuance of common stock under a registered direct offering, $2,457,352 in proceeds from the issuance of common stock under the at-the-market offering, and $1,604,000 in borrowings from Conduit Capital U.S. Holdings, LLC. Condish Quendemy Energy, LLC, continued to recovery, partially offset by $1,595,364 in payments against loans payable and $856,736 in CVR distributions. In connection with the SUNation NY acquisition, on November 9, 2022, the company issued a $5,486,000 long-term promissory note, the long-term note. The long-term note was unsecured and matured on November 9, 2025. It carried an annual interest rate of 4% until the first anniversary of issuance, then 8% thereafter until the long-term note was paid in full. The company was required to make a principal payment of $2.74 million on the second anniversary of the long-term note. The long-term note may be prepaid at our option at any time without penalty. On April 10, 2025, the long-term note was amended and restated, whereby the principal amount of $5,486,000 previously due and payable under the original long-term note, together with all accrued and unpaid interest owing thereunder, shall be due and payable on May 1, 2028, and such amended note became a senior secured instrument. Principal and interest payments under the amended long-term note are payable monthly on the first day of each month, commencing on June 1, 2025, for 36 consecutive months thereafter. Additionally, pursuant to the terms of that certain senior secured contingent note instrument entered into on April 10, 2025, the unearned 2024 earnout was rescheduled and is based on the earnout terms set forth therein, pursuant to the financial conditions and terms covering each of fiscal years 2024 and 2025, and if attained, shall be payable in fiscal year 2026, which payment is further conditioned on the continued employment of the note holders at the time of such earnout payment trigger date. Based on the company's current financial position and the company's forecasted future cash flows for 12 months beyond the date of issuance of these financial statements, substantial doubt exists around the company's ability to continue as a going concern for a reasonable period of time. As noted in Notes 8 and 11, the company raised capital and satisfied certain outstanding debt obligations during 2025. However, there remains uncertainty related to our future cash flows, as it relies on the ability to generate enough cash flow from its operating segments to cover the company's corporate overhead costs. As a result, the company requires additional funding and seeks to raise capital through sources that may include public or private equity offerings, debt financings, and/or strategic alliances. On February 27, 2025, the company entered into a securities purchase agreement with certain institutional investors for the purchase and sale of an aggregate of $20.0 million in securities, with $15.0 million in gross proceeds in the first closing on February 27, 2025, and $5.0 million in gross proceeds in the second closing on April 7, 2025. While the company was able to use the proceeds to pay off approximately $12.6 million in outstanding debt and contingent liability obligations, it was not sufficient to cover all of the company's current and future obligations. Additional funding may not be available on terms acceptable to the company or at all. If the company is unable to raise additional funds, it would have a negative impact on the company's business, results of operations, and financial condition. To the extent that additional funds are raised through the sale of equity or securities convertible into or exercisable for equity securities, the issuance of securities will result in dilution to the company's shareholders, contingent value rights, and impact on cash. The company issued CVRs prior to the closing of the merger to CSI shareholders of record on the close of business on March 25, 2022. The CVR entitles the holder to a portion of the cash equivalents, investments, and net proceeds of any divestiture, assignment, or other disposition of all legacy assets of CSI and/or its legacy subsidiaries, JDL and ESESA, that are related to CSI's pre-merger business, assets, and properties that occurred during the period following the closing of the merger and ending initially on March 28, 2024, but was extended through December 31, 2024 by the First Amendment to the Contingent Value Rights Agreement entered into on March 27, 2024. This was extended again through December 31, 2025 by the Second Amendment to the Contingent Value Rights Agreement entered into on December 30, 2024. The CVRs were settled during the fourth quarter of 2025 with a final distribution payment of $276,000 in December 2025. There are no further obligations during the CVRs. The company has no freestanding or embedded derivatives. The company's policy is to not use freestanding derivatives and to not enter into contracts with terms that cannot be designated as normal purchases or sales. The company's investments are in money markets that earn interest at prevailing market rates and, as such, do not have material risk exposure. Based on the company's operations, in the opinion of management, the company is not exposed to material future losses due to market risk. We have audited the accompanying consolidated balance sheet of SUNation Energy Inc., the company, as of December 31, 2025, the related consolidated statements of operations, comprehensive income, if required, stockholders' equity and cash flows for the year ended December 31, 2025, and the related notes, collectively referred to as the financial statements. In our opinion, based on our audit, the financial statements present fairly, in all material respects, the financial position of the company as of December 31, 2025, and the results of its operations and its cash flows for the year ended December 31, 2025, in conformity with accounting principles generally accepted in the United States of America. The accompanying consolidated financial statements have been prepared assuming that the company will continue as a going concern. As more fully described in Note 15, the company has incurred significant losses and needs to raise additional funds to meet its obligations and sustain its operations. These conditions raise substantial doubt about the company's ability to continue as a going concern. Management's plans in regard to these matters are also described in Note 15. The consolidated financial statements do not include any adjustments that might result from the outcome of this uncertainty. As discussed in Note 1 to the consolidated financial statements, the company effected a reverse stock split on April 21, 2025, which has been retrospectively applied to all periods presented. The financial statements for the years ended December 31, 2024, before the retrospective adjustment for the reverse stock split described in Note 1, were audited by other auditors whose report dated April 15, 2025, expressed an unmodified opinion on those statements. We audited the adjustments described in Note 1 that were applied to retrospectively recast the financial statements. In our opinion, such retrospective adjustments are appropriate and have been properly applied. We were not engaged to audit, review, or apply any procedures to the 2024 consolidated financial statements of the company other than with respect to these retrospective adjustments for the reverse stock splits, and, accordingly, we do not express an opinion or any other form of assurance on the 2024 consolidated financial statements taken as a whole. At December 31, 2025, the company's goodwill totaled $17,443,869, allocated between the HEC $6,727,231 and SUNation $10,716,638 reporting units. As described in Notes 2 and 7 to the consolidated financial statements, management evaluates goodwill impairment at the reporting unit level annually or when events indicate possible impairment. A quantitative analysis was conducted as of September 30, 2025, using a combination of income and market approaches to estimate fair value, assisted by a third-party specialist. Management concluded that the fair values of both reporting units exceeded their carrying values and no impairment charge was recognized. The principal considerations for their amicus sham was that auditing the goodwill impairment assessment involved significant judgment due to the use of complex valuation models and subjective assumptions, including projected revenue growth, EBITDA margins, terminal growth, discount rates, and selection of comparable companies. These assumptions are sensitive to expectations of future market and economic conditions. As described in Notes 2 and 11 to the consolidated financial statements, the company entered into a securities purchase agreement in the first quarter of 2025 involving common stock, pre-funded warrants, and, contingent on shareholder approval, additional common stock or warrants and Series A and B warrants. The contingent forward contract for the second closing and the Series A and B warrants were accounted for as derivative liabilities at fair value, with changes in fair value recognized through earnings. Upon shareholder approval in the second quarter of 2025, the contingent forward contract was derecognized, and the Series B warrants were derecognized upon exercise. The fair value measurement of these instruments required significant management judgment, use of complex models, and involved unobservable inputs and the selection of comparable companies to estimate expected stock price volatility. The company engaged a third-party specialist to assist with the fair value analysis. The principal considerations for the critical audit matter conclusion is that auditing the accounting and valuation of these derivative liabilities involved complex evaluation of applicable accounting guidance, ASC 480 and ASC 815, involvement of our valuation specialists, and assessment of management's estimates including volatility, guideline public companies, and adjustment to stock price for dilutionary effective of the warrant issuances. We have audited, before the effects of the adjustments to retrospectively apply the impact of the April 2025 reverse stock split described in Note 1, the accompanying consolidated balance sheet of SUNation Energy Inc. and subsidiaries, the company, as of December 31, 2024, and the related consolidated statement of operations and comprehensive loss, changes in stockholders' equity, and cash flows for the year ended December 31, 2024, and the related notes, collectively referred to as the consolidated financial statements. In our opinion, the 2024 consolidated financial statements, before the effects of the adjustments to retrospectively apply the impact of the April 2025 reverse stock split described in Note 1, present fairly, in all material respects, the financial position of the company as of December 31, 2024, and the results of its operations and its cash flows for the year ended December 31, 2024, in conformity with accounting principles generally accepted in the United States of America. We were not engaged to audit, review, or apply any procedures to the adjustments to retrospectively apply the impact of the April 2025 reverse stock split described in Note 1, and, accordingly, we do not express an opinion or any other form of assurance about whether such adjustments are appropriate and have been properly applied. Those adjustments were audited by CBIZ CPAs PC. The 2024 consolidated financial statements, before the effects of the adjustments discussed in Note 1, are not presented herein. Substantial doubt about the company's ability to continue as a going concern. The accompanying consolidated financial statements have been prepared assuming that the company will continue as a going concern. As discussed in Note 15 to the consolidated financial statements, the company's current financial position and the company's forecasted future cash flows for 12 months beyond the date of issuance of these financial statements indicate substantial doubt around the company's ability to continue as a going concern. Management's plans in regards to these matters are also described in Note 15. The financial statements do not include any adjustments that might result from the outcome of this uncertainty. Description of business: SUNation Energy Inc. SUNation Energy, we, or the company, is a Delaware corporation whose shares of common stock are listing on the Nasdaq stock market under its trading symbol SUNE. The company is a domestic operator and consolidator of residential solar, battery storage, and grid services solutions. Our strategy is focused on acquiring, integrating, and growing leading local and regional solar, storage, and energy services companies nationwide. On January 3, 2024, the company's shareholders approved a reverse stock split of the company's common stock at a ratio within a range of 1:2 and 1:15, and granted the company's board of directors the discretion to determine the timing and ratio of the split within such range. On May 28, 2024, the company's board of directors determined to effect the reverse stock split of the common stock at a 1:15 ratio, the June reverse stock split, and approved an amendment to the Fourth Amended and Restated Articles of Incorporation of the company to effect the June reverse stock split. As a result of the June reverse stock split, on the June effective date, every 15 shares of common stock then issued and outstanding automatically were combined into one share of common stock, with no change in par value per share. No fractional shares were outstanding following the June reverse stock split, and any fractional shares that would have resulted from the June reverse stock split were settled in cash. The number of shares of common stock outstanding was reduced from 108,546,773 to 7,235,731, with 720.901 fractional shares paid out in cash, totaling $1,132. The total number of shares authorized for issuance was reduced to 7,500,000 in proportion to the June reverse stock split ratio. On July 19, 2024, the company's shareholders approved a reverse stock split of the company's common stock at a ratio within a range of 1:2 and 1:200, and granted the company's board of directors the discretion to determine the timing and ratio of the split within such range. Additionally, the shareholders also approved an increase in authorized shares to 133,333 shares. On October 1, 2024, the company's board of directors determined to effect the reverse stock split of the common stock at a 1:50 ratio, the October reverse stock split, and approved an amendment to the Fourth Amended and Restated Articles of Incorporation of the company to effect the October reverse stock split. As a result of the October reverse stock split, on the October effective date, every 50 shares of common stock then issued and outstanding automatically were combined into one share of common stock, with no change in par value per share. No fractional shares were outstanding following the reverse stock split, and any fractional shares that would have resulted from the October reverse stock split were settled in cash. The number of shares of common stock outstanding was reduced from 67,260,696 to 1,344,841, with 372.92 fractional shares payable in cash, totaling $1,891. The total number of shares authorized for issuance was reduced from 133,333,333 to 2,666,667 in proportion to the October reverse stock split ratio. The number of shares authorized for issuance was later increased to 25 million as a result of the reincorporation. Effective as of the same time as the June 2024 reverse stock split and October 2024 reverse stock split, collectively known as the reverse stock splits, the number of shares of common stock available for issuance under the company's equity compensation plans were automatically reduced in proportion to the reverse stock splits ratio. Upon effectiveness, the reverse stock splits also resulted in reductions in the number of shares of common stock issuable upon exercise or vesting of equity awards in proportion to the reverse stock splits ratios, and caused a proportionate increase in exercise price or share-based performance criteria, if any, applicable to such awards. On April 3, 2025, the company's shareholders approved a reverse stock split of the company's common stock at a ratio within a range of 1-for-2 and 1-for-200, and granted the company's board of directors the discretion to determine the timing and ratio of the split within such range. Additionally, the shareholders also approved an increase in authorized shares to 1 billion shares. On April 9, 2025, the company's board of directors determined to effect the reverse stock split of the common stock at a 1-for-200 ratio, the April reverse stock split, and approved an amendment, April reverse stock split amendment, to its certificate of incorporation to effect the April reverse stock split. As a result of the April reverse stock split, on the April effective date, every 200 shares of common stock then issued and outstanding automatically were combined into 1 share of common stock, with no change in par value per share. No fractional shares were outstanding following the April reverse stock split, and any fractional shares that would have resulted from the April reverse stock split were rounded up to the nearest whole share. The number of shares of common stock outstanding was reduced from 672,799,910 to 3,406,614. The effects of the reverse stock splits have been reflected in the consolidated financial statements for all periods presented. Impact of the reverse stock splits. The impact of the reverse stock splits was applied retroactively for all periods presented in accordance with applicable guidance. Therefore, prior period amounts are different than those previously reported. Cash and cash equivalents. For purposes of the consolidated statements of cash flows, the company considers all highly liquid investments with a maturity of 3 months or less at the time of purchase to be cash equivalents. The company may invest in short-term money market funds that are not considered to be bank deposits and are not insured or guaranteed by the Federal Deposit Insurance Company of Voluntary Deposit Services. These money market funds seek to preserve the value of the investment at $1 per share. However, it is possible to lose money investing in these funds. Inventories, which consist primarily of materials and supplies used in the installation of solar systems, are stated at the lower of cost or net realizable value, with costs computed on a weighted average cost basis. The company periodically reviews its inventories for excess and obsolete items and adjusts carrying costs to estimated net realizable values when they are determined to be less than cost. The inventory reserve was $362,277 and $226,439 at December 31, 2025 and 2024, respectively. Property, plant, and equipment. Property, plant, and equipment are recorded at cost. Depreciation is computed using the straight-line method. Depreciation included in cost of sales and selling, general, and administrative expenses was $265,615 and $332 for 2025 and 2024, respectively. Maintenance and repairs are charged to operations, and additions or improvements are capitalized. Items of property sold, retired, or otherwise disposed of are removed from the asset and accumulated depreciation accounts, and any gains or losses on disposal are reflected in the statements of operations. Goodwill and other intangible assets. Goodwill represents the amount by which the purchase prices, including liabilities assumed, of acquired businesses exceed the estimated fair value of the net tangible assets and separately identifiable intangible assets of these businesses. Definite-lived intangible assets, consisting primarily of trade names, technology, and backlog, are amortized on a straight-line basis over the estimated useful life of the asset. Goodwill is not amortized, but is tested at least annually for impairment. The company reassesses the value of our reporting units and related goodwill balances annually on October 1st and at other times if events have occurred or circumstances exist that indicate the carrying amount of goodwill may not be recoverable. The company recognized an impairment loss of $3,101,981 related to the goodwill of its HEC segment during the year ended December 31, 2024. See Note 7, Goodwill and Intangible Assets, for further information. Recoverability of long-lived assets and intangible assets. The company reviews its long-lived assets and definite-lived intangible assets for impairment whenever events or changes in circumstances indicate that the carrying amounts of the assets may not be fully recoverable. If indicators of impairment exist, management identifies the asset group that includes the potentially impaired long-lived asset at the lowest level at which there are separate, identifiable cash flows. If the fair value, determined as the total of the expected undiscounted future net cash flows for the asset group, is less than the carrying amount of the asset, a loss is recognized for the difference between the fair value and carrying amount of the asset. The company recognized a loss of $750,000 related to the technology intangible asset within the HEC segment during the year ended December 31, 2024. See Note 7, Goodwill and Intangible Assets, for further information. The company has issued various financial instruments, including preferred stock, instruments containing redemption rights that are either within the control of the holder or subject to redemption upon the occurrence of uncertain events not solely within the company's control, are classified as redeemable or mezzanine equity. The purpose of this classification is to convey that such a security may not be permanently part of equity and could result in a demand for cash, securities, or other assets of the entity in the future. See Note 11, Equity, for further discussion regarding the reclassification of the company's convertible preferred stock from permanent equity to mezzanine equity during the first quarter of 2024 and the reclassification from mezzanine equity to permanent equity in the third quarter of 2024. The company accounts for warrants as either equity classified or liability classified instruments based on an assessment of the warrant's specific terms and applicable authoritative guidance, ASC 480, Distinguishing Liabilities from Equity, and ASC 815, Derivatives and Hedging. Management's assessment considers whether the warrants are freestanding financial instruments pursuant to ASC 480, whether they meet the definition of a liability pursuant to ASC 480, and whether the warrants meet all of the requirements for equity classification under ASC 815. See Note 11, Equity, for further discussion regarding the reclassification of the company's PIPE warrants from equity to liabilities during the first quarter of 2024 and the reclassification from liabilities to equity in the third quarter of 2024. For issued or modified warrants that do not meet all the criteria for equity classification, such warrants are required to be recorded as a liability initially at their fair value on the date of issuance and subsequently remeasured to fair value on each balance sheet date thereafter. Changes in the estimated fair value of liability classified warrants are recognized in other income, expense in the consolidated statements of operations in the period of change. Derivative liabilities. The company evaluates its contracts to determine if those contracts qualify as derivatives under ASC 815. For derivative financial instruments that are accounted for as liabilities, including the company's contingent forward contract, the derivative instrument is initially recorded at its fair value and is then subsequently remeasured to fair value on each balance sheet date thereafter. Any changes in fair value are recorded in other income, expense in the consolidated statements of operations in the period of change. Revenue is recognized when there is a transfer of control of promised goods or services to customers in an amount that reflects the consideration that the company expects to be entitled to in exchange for those goods or services. The company sells solar power systems under construction and development agreements to residential and commercial customers. The completed system is sold as a single performance obligation. For residential contracts, revenue is recognized at the point in time when the systems are placed into service. Any advance payments received in the form of customer deposits are recorded as contract liabilities. Commercial contracts are generally completed within 3 to 12 months from commencement of construction. Construction on large projects may be completed within 18 to 24 months, depending on the size and location of the project. Revenue from commercial contracts are recognized under a percentage of completion method, measured by the percentage of hours incurred to date against estimated total hours budgeted for each contract. Because of inherent uncertainties in estimating costs, it is at least reasonably possible that the estimates used will change within the near future. Contract costs include all direct material, labor costs, and those indirect costs related to contract performance, such as indirect labor and other supplies. Selling, general, and administrative costs are charged to expense as incurred. Provisions for estimated losses on uncompleted contracts are made in the period in which such losses are determined. Changes in job performance, job conditions, and estimated profitability may result in revisions to costs and revenues, which are recognized in which the revisions are determined. changes in estimated job profitability resulting from job performance, job conditions, contract penalty provisions, claims, change orders, and settlements are accounted for as changes in estimates in the current period. The state of Hawaii imposes a gross receipts tax on all business operations done in Hawaii. The company records the tax revenue and expense on a gross basis. Gross excise tax revenue was $1,002,557 and $744,570, and gross excise tax expense was $1,004,490 and $763,370 for the years ended December 31st, 2025 and 2024, respectively. Cost of sales consist of direct and indirect material and labor costs for solar energy system installations, as well as warranty costs, permitting fees, financing fees, and overhead including costs related to procurement, warehousing, and inventory management. Employee retirement benefits. The company has an employee savings plan, 401k, and matches a percentage of employee contributions up to 6% of compensation. Employer contributions to the plan in 2025 and 2024 were $331,715 and $303,878, respectively. Share-based compensation. The company accounts for share-based compensation awards on a fair value basis. The estimated grant date fair value of each stock-based award is recognized in the statement of operations over the requisite service period, generally the vesting period. The company recognizes forfeitures as they occur. SUNation New York warrants its products for various periods against defects in material or installation workmanship. The manufacturers of the solar panels and the inverters provide a warranty period of generally 25 years and 10 years, respectively. SUNation New York will assist its customers in the event that the manufacturer's warranty needs to be used to replace a defective solar panel or inverter. SUNation New York provides for warranty up to the lifetime of the system on the installation of a system and all equipment and incidental supplies other than solar panels and inverters that are recovered under the manufacturer's warranty. SUNation New York provides extended workmanship warranties to the customer for up to 25 years for the service of inverters, which is reimbursed by the manufacturer. The company estimates its warranty obligations upon installation, an expense included in cost of sales, based on management's best estimate of the probable costs to be incurred in honoring its warranty commitment. Advertising costs are expensed as they are incurred. Advertising expense was $847,779 and $746,805 for the years ended December 31st, 2025 and 2024, respectively. Operating segments are defined as components of an enterprise for which separate financial information is available and evaluated regularly by the chief operating decision-maker or decision-making group in deciding the method to allocate resources and assess performance. Our chief operating decision-maker, CODM, is a committee comprised of our chief executive officer, chief operating officer, and chief financial officer. Based on the financial information presented to and reviewed by our CODM, in deciding how to allocate resources and in assessing performance, we have determined we have two operating and reportable segments. See Note 13, Segment Information, for further discussion. Certain prior period amounts within operating activities in the statement of cash flows have been reclassified to conform to the current period presentation. These reclassifications had no effect on previously reported net loss, total assets, total liabilities, or stockholders' equity. Concentrations of risk. Financial instruments which potentially subject the company to concentrations of credit risk consist primarily of cash and accounts receivable. The associated risk of concentration for cash is mitigated by banking with institutions with high credit ratings. At certain times, amounts on deposit exceed FDIC insurance limits. The company has limited credit risk in accounts receivable, as most contracts are paid through outside customer financing. The company is not dependent on any single customer, and the loss of any customer would not adversely impact the company's operating results or financial position. The company depends on a limited number of suppliers for its solar panels and other system components. During the years ended December 31st, 2025 and 2024, the top 5 suppliers collectively accounted for approximately 47% and 40% of the company's total accounts payables, respectively. There were no customers greater than 10% of revenue or accounts receivable during the years ended December 31st, 2025 and 2024. Basic net loss attributable to common shareholders per common share is based on the weighted average number of common shares outstanding during each year. Diluted net loss attributable to common shareholders per common share adjusts for the dilutive effect of potential common shares outstanding. The company had 11,587,121 in deemed dividends during the year ended December 31st, 2024, which decreases the numerator in the net loss per share calculation. The company's only potential additional common shares outstanding are common shares that would result from the conversion of the convertible preferred shares, warrants, convertible debt, and shares associated with the long-term incentive compensation plans, which resulted in no dilutive effect for the year ended December 31, 2025. The company calculates the dilutive effect of outstanding options, warrants, and unvested shares using the treasury stock method and the dilutive effect of outstanding preferred shares using the if-converted method. There were no options or deferred stock awards excluded from the calculation of diluted earnings per share because there were no outstanding options or deferred stock awards as of both December 31, 2025 and 2024. Restricted stock units totaling 3 and 9 would have been excluded from the calculation of diluted earnings per share for the years ended December 31, 2025 and 2024, respectively, even if there had not been a net loss in those periods, because the exercise price was greater than the average market price of common stock during the period. Accounting standards issued. In October 2023, the FASB issued ASU 2023-06, Disclosure Improvements, Codification Amendments in response to the SEC's Disclosure Update and Simplification Initiative, which is intended to clarify or improve disclosure and presentation requirements of a variety of topics. Many of the amendments will allow users to more easily compare entities subject to the SEC's existing disclosures with those entities that were not previously subject to the requirements and align the requirements in the FASB accounting standard codification with the SEC's regulations. The amendments in ASU 2023-06 will become effective on the date the related disclosures are removed from Regulation SX or Regulation SK by the SEC, and will no longer be effective if the SEC has not removed the applicable disclosure requirement by June 30, 2027. Early adoption is prohibited. The company is currently evaluating this ASU and the impact it may have on its consolidated financial statements. In November 2024, the FASB issued ASU 2024-03, Income Statement, Reporting Comprehensive Income, Expense Disaggregation Disclosures, Subtopic 220-40, Disaggregation of Income Statement Expenses, which requires disclosure in the notes to the financial statements of specified information about certain costs and expenses. The amendments are effective for fiscal years beginning after December 15, 2026, and for interim periods within fiscal years beginning after December 15, 2027. Early adoption is permitted. The amendments should be applied either prospectively to financial statements issued for reporting periods after the effective date of this ASU or retrospectively to any or all prior periods presented in the financial statements. The company is currently evaluating this ASU and the impact it may have on its consolidated financial statements. In November 2024, the FASB issued ASU 2024-04, Debt with Conversion and Other Options, which clarifies the requirements for determining whether certain settlements of convertible debt instruments should be accounted for as an induced conversion. This ASU is effective for annual periods beginning after December 15, 2025, and interim reporting periods within those annual report periods. Early adoption is permitted for all entities that have adopted the amendments in ASU Update 2020-06. Adoption can be on a prospective or retrospective basis. The company is currently evaluating this ASU and the impact it may have on its consolidated financial statements. In July 2025, the FASB issued ASU 2025-05, Financial Instruments, Credit Losses, Topic 326, Measurement of Credit Losses for Accounts Receivable and Contract Assets. ASU 2025-05 provides a practical expedient that all entities can use when estimating expected credit losses for current accounts receivable and current contract assets arising from transactions accounted for under ASC 606, Revenue from Contracts with Customers. Under this practical expedient, an entity is allowed to assume that the current conditions it has applied in determining credit loss allowances for current accounts receivable and current contract assets remain unchanged for the remaining life of those assets. ASU 2025-05 is effective for fiscal years beginning after December 15, 2025, and interim reporting periods in those years. Entities that elect the practical expedient and, if applicable, make the accounting policy election are required to apply the amendments prospectively. The company is currently evaluating this ASU and the impact it may have on its consolidated financial statements. In September 2025, the FASB issued ASU 2025-06, Intangibles, Goodwill, and Other Internal Use Software, Subtopic 350-40, Targeted Improvements to the Accounting for Internal Use Software, which removes all references to software development project stages and requires that an entity capitalize software costs when both 1. Management has authorized and committed to funding the software project, and 2. It is probable that the project will be completed and the software will be used to perform the function intended, referred to as the probable to complete recognition threshold. The ASU is effective for fiscal years beginning after December 15, 2027, and interim periods within those fiscal years. Early adoption is permitted. The company is currently evaluating this ASU and the impact it may have on its consolidated financial statements. In December 2025, the FASB issued ASU 2025-11, Interim Reporting, Topic 270, Narrow Scope Improvements, which clarifies interim disclosure requirements by improving the navigability of the required interim disclosures and clarifying when that guidance is applicable. The standard is effective for interim reporting periods within annual reporting periods beginning after December 15, 2027. Early adoption is permitted. The company is currently evaluating this ASU and the impact it may have on its consolidated financial statements. Accounting standards adopted in December 2023. The FASB issued ASU 2023-09, Income Taxes, Topic 740, Improvements to Income Tax Disclosures, which expands disclosures in an entity's income tax rate reconciliation table and regarding cash taxes paid both in the U.S. and foreign jurisdictions. This ASU is effective for fiscal periods beginning after December 15, 2024, with early adoption permitted. The company adopted this ASU effective January 1, 2025, and applied the new disclosure requirements prospectively as of the adoption date. See further information within Note 12, Income Taxes. Disaggregation of revenues. Revenues are recognized when control of the promised goods or services is transferred to our customers in an amount that best reflects the consideration we expect to receive in exchange for those goods or services. Contract assets represent costs and earnings in excess of amounts billed and direct costs, including commissions, financing, and permitting fees paid prior to recording revenue. Contract liabilities represent amounts billed to clients in excess of revenue recognized to date and billings in excess of costs and earnings. Retainage on commercial revenue contracts is included within accounts receivable and totaled $455,660 and $189,880 at December 31, 2025 and 2024, respectively. Contract assets were $658,177, $560,648, and $57,241 at December 31, 2024, and 2023, respectively. Contract liabilities were $2,737,151, $214,483, and $2,552,452 at December 31, 2025, 2024, and 2023, respectively. During 2024, $2,552,452 within contract liabilities as of December 31, 2023 was recognized within revenue. During 2025, $2,186,702 within contract liabilities as of December 31, 2024 has been recognized within revenue. The company recognizes assets and liabilities for the rights and obligations created by leases that extend more than 12 months from the date of the balance sheet. Right of use (ROU) assets represent our right to use an underlying asset for the lease term. while lease liabilities represent our obligation to make lease payments arising from the lease. Lease ROU assets and liabilities are recognized at the commencement date of a lease based on the present value of lease payments over the lease term. Because the rate implicit in each individual lease is not readily determinable, the company uses its incremental borrowing rate to determine the present value of the lease payments. In 2022, the company entered into operating leases for 2 office locations, including one in Hawaii in April 2022 and one in New York in November 2022, upon the acquisition of SUNation in UI. In 2022, the company had also entered into an operating lease for its corporate offices in Minnesota that commenced on January 1, 2023. In March 2023, the company entered into an operating lease for an additional office location in Florida. Effective September 30, 2024, the company entered into a lease termination agreement with our Minnesota office landlord, pursuant to which the company paid a termination fee totaling $189,000 to be paid at $13,500 per month for a period of 14 months from entry into the lease termination, as well as the company waiving its right to its original security deposit provided at entry into the original lease in the amount of $35,434. The lease termination resulted as a decrease to the company's operating lease right-of-use assets, totaling $415,674, and operating lease liabilities totaling $424,694, which, along with the termination fee and write-off the security deposit, resulted in a loss on the termination of the lease totaling $215,415, recorded in operating expenses in the consolidated statements of operations for the year ended December 31, 2024. There is no remaining liability as December 31, 2025. During the third quarter of 2025, the company terminated its Florida office operating lease and incurred $12,873 in additional expense related to a termination fee, forfeiture of the security deposit, and other fees. The lease termination resulted in a decrease to the company's operating lease right of use assets, totaling $37,544, and operating lease liabilities totaling $39,104, which, along with the additional expenses, resulted in a loss on the termination of the lease totaling $11,313, recorded in operating expenses in the consolidated statements of operations for the year ended December 31, 2025. These remaining leases have remaining lease terms of 6 to 10 years. One lease includes a 3% rent adjustment on each anniversary of the lease, and the other includes a fixed annual rent adjustment of $6,840. As of December 31, 2025, total RU assets and operating lease liabilities were $3,315,411 and $3,450,718 to sellers, respectively. All operating lease expense is recognized on a straight-line basis over the lease term. In the years ended December 31, 2025 and 2024, the company recognized $566,745 and $696,141 in lease expense, respectively. The company reassesses the value of our reporting units and related goodwill balances annually on October 1st and at other times if events have occurred or circumstances exist that indicate the carrying amount of goodwill may not be recoverable. On July 4th, 2025, the President signed H.R. 1, the One Big Beautiful Bill Act, or OBBBA, into law, which accelerates the phase-outs and terminations of various eligible tax credits enacted as part of the Inflation Reduction Act and places restrictions on continued receipt of tax credits by specified foreign entities and foreign-influenced entities. The OBBA terminates several consumer-facing tax credits, including the Residential Clean Energy Credit, Section 25D, and the Energy Efficient Home Improvement Credit, Section 25C, effective at the end of 2025. The Section 25D credit previously allowed homeowners to claim a 30% credit for installing rooftop solar panels and related equipment. The OBBA also has an accelerated phase-out of the Clean Electricity Investment Tax Credit, Section 48E, and the Clean Electricity Production Tax Credit, 45Y. In this accelerated phase-out, projects must begin construction by July 4, 2026, or be placed in service by December 31, 2027, to qualify for these credits. The company performed a quantitative assessment related to the recoverability of our goodwill for our two reporting units as a result of the material decline in our forecasted revenues and operating results. The company estimated the fair value of the reporting units using an equally weighted combination of an income approach and market approach. Under the income approach, the company discounted the estimated future cash flows of each reporting unit using a rate of return commensurate with the reporting unit's risk. Under the market approach, the company utilized the guideline public company method based on market revenue multiples of comparable publicly traded companies. The company concluded that the fair values of the SUNation NY and HEC reporting units exceeded its carrying value as of September 30th, 2025 and October 1st, 2025, and no impairment charge was necessary. As a result of the implications of the OBBA, as noted above, the company performed an impairment test on the trade names and trademarks intangible assets associated with both the HEC and SUNation NY reporting units as of September 30th, 2025. The company performed the analysis under ASC 360 and no impairment charge was realized. At December 31, 2024, we performed an interim quantitative assessment related to the recoverability of our goodwill for our two reporting units as a result of a material decline in our stock price and forecasted revenues and operating results. The company estimated the fair value of the reporting units using an equally weighted combination of an income approach and market approach. Under the income approach, the company discounted the estimated future cash flows of each reporting unit using a rate of return commensurate with the reporting unit's risk. Under the market approach, the company utilized the guideline public company method based on market revenue multiples of comparable publicly traded companies. The company concluded that the fair value of the HEC reporting unit did not exceed its carrying value as of December 31st, 2024, and recorded an impairment loss of $3,101,981 in its consolidated statement of operations. During the year ended December 31st, 2024, the company performed an impairment test for the asset group associated with the developed technology intangible asset. The test included comparing the sum of the estimated undiscounted future cash flow attributable to this asset and its carrying amounts, and recognizing an impairment for the amount to which the carrying amount exceeds the fair value of the asset. The company recognized an impairment charge of $750,000 on its developed technology intangible asset, as the company determined in the fourth quarter of 2024, as this asset is no longer relevant for the company's continued and future operations. Amortization expense on these identifiable intangible assets was $2,237,500 and $2,837,500 in 2025 and 2024, respectively. The weighted average remaining useful life at December 31st, 2025 was 4.5 years. The estimated future amortization expense for identifiable intangible assets during the next 5 fiscal years is as follows. Revolving line of credit. On April 14, 2025, the company entered into a secured revolving line of credit agreement, the Revolving Credit Agreement, with MBB Energy, LLC, affiliate of the company, as lender, providing for a $1.0 million revolving credit facility, the revolver. The revolver matures on April 14, 2026, unless earlier terminated or extended pursuant to its terms. Borrowings, if any, under the revolver will bear interest at a fixed annual rate of 8%, payable monthly in arrears on the first day of each calendar month. The revolving credit agreement includes customary affirmative and negative covenants, as well as standard events of default, which, if triggered, may permit the lender to accelerate all outstanding obligations under the facility. The company may repay outstanding borrowings at any time without penalty. As of December 31st, 2025, no amounts have been drawn on the revolver. As of December 31st, 2025, the company was in compliance with all covenants and other requirements of the revolving credit agreement. See Note 16, Subsequent Events, for drawdowns made under this facility in January 2026. Pineapple Energy LLC had a loan in an original amount of $7,500, payable to Hercules Capital Inc., Hercules, under a loan and security agreement, the Term Loan Agreement. This loan accrues interest at 10%, payable in kind, PIK-WEK, and was initially due and payable on December 10, 2023. There are no financial covenants associated with this loan. This loan was used to acquire fixed assets, inventory, and intangible assets of Sungevity in an asset acquisition in December 2020. As the transaction did not involve the exchange of monetary consideration, the assets were valued at the company's most reliable indication of fair value, which was debt issued in consideration for the assets. Accordingly, Pineapple Energy assessed the fair market value of the debt instrument at $4,768,000 at the asset acquisition date, a non-recurring Level 3 fair value input. The company initially accreted the value of the debt over its life at a discount rate of approximately 25%. On December 16, 2021, the term loan agreement was amended, whereby the maturity date was extended to December 31, 2024, subject to various prepayment criteria. In addition, the amendment provided that $4,500,000 plus all accrued and unpaid interest and expenses were to be repaid upon closing of the merger and receipt of the PIPE funds, with the remaining principal to be paid upon the loan maturity date. The amendment represented a modification to the loan agreement with the existing lender, as both the original loan agreement and the amendment allow for immediate prepayment, and the company passed the cash flow test. On May 31, 2023, the term loan agreement was further amended, the Second Amendment, primarily for the purpose of obtaining consent for the senior financing from Decathlon Specialty Finance, LLC, the Decathlon financing, the proceeds of which were partially applied to repay $1,500,000 of the principal amount of the Hercules term loan. At the time of the Second Amendment and prior to the repayment, the aggregate remaining balance of the term loan, including principal and interest, was $3,375,742. The Second Amendment also extended the maturity date of the term loan to June 2, 2027, and set the interest rate at 10%, 10.0%, payable monthly, and removing the PIK interest. The aggregate remaining principal balance of $1,875,742, along with interest, is payable in equal monthly installments of principal and interest beginning on July 3, 2023, and continuing on the first business day of each month thereafter. The Second Amendment represented a modification under ASC 470-50, as the original loan agreement and the amended agreement are not substantially different. On July 22, 2024, the term loan agreement was further amended, the Third Amendment, primarily for the purpose of obtaining consent for the bridge loan financing from Conduit Capital U.S. Holdings, LLC, and MBB Energy, LLC. The Third Amendment represented a modification under ASC 470-50, as the original loan agreement and the amended agreement were not substantially different. The company also entered into a joinder and amendment to subordination agreement, the Joinder Agreement, with Decathlon, Hercules Capital Inc., Conduit, and MBB. Pursuant thereto, Conduit and MBB became parties to the subordination agreement dated June 21, 2023, among the company, Decathlon, and Hercules Capital Inc. In accordance with the Joinder Agreement, Conduit and MBB agreed to subordinate their respective security interests in the company's assets to the first priority security interest of Decathlon and the second security priority interest of Hercules. On September 20, 2024, the term loan agreement was further amended, the Fourth Amendment, whereby Hercules waived the October 2024 amortization payment. The company made payment of monthly interest on October 1, 2024, and resumed making monthly payment of principal on November 1, 2024, pursuant to the loan agreement. The Fourth Amendment represented a modification, as both the original loan agreement and the amendment are not substantially different. At December 31, 2024, the combined loan and accrued interest balance was $680,513. A new effective interest rate of approximately 48.6% was established during the second quarter of 2023, based on the carrying value of the revised cash flows. As of March 3, 2025, the combined loan and accrued interest balance, net of unamortized debt discount and debt issuance costs, was $682,955, and the aggregate remaining balance of the term loan, including principal and interest, was $1,200,000. $230,555. However, the parties to the term loan agreement agreed to a reduced aggregate repayment amount of $1,138,263 if voluntarily repaid early in full. On March 3, 2025, the company repaid the remaining balance of this loan in full, using a portion of the proceeds from the first tranche of the securities offering, which occurred on February 27, 2025. See Note 11, Equity, for further details. As a result of this complete repayment, the term loan agreement has been terminated, together with other agreements and instruments related thereto, and no further monthly or other payments or remuneration of any kind shall be paid or be payable following the termination of this term loan agreement, and no early termination penalties or prepayment premium were incurred by the company in connection with the termination of this loan agreement. The company recorded a loss on extinguishment of debt of $455,308 in connection with the repayment of the loan, which represents the difference between A, the reduced aggregate repayment amount, and B, the carrying amount of the loan at the repayment date, which included the outstanding principal and interest balance, less unamortized debt discount and debt issuance costs. Interest and accretion expense was $100,450 and $721,061 for the years ended December 31, 2025 and 2024 respectively. The loan was collateralized by all of Pineapple Energy LLC's personal property and assets. Decathlon Fixed Loan. On June 1, 2023, the company entered into a revenue loan and security agreement, the loan agreement, with Decathlon Specialty Finance LLC, Decathlon. The loan agreement provides for a loan facility for the company in the maximum amount of $7.5 million, with a maturity date of June 1, 2027, the Decathlon Fixed Loan, with the full amount being advanced to the company upon execution of the loan agreement. The Decathlon Fixed Loan contains customary conditions, representations and warranties, affirmative and negative covenants, mandatory prepayment provisions, and events of default. The advances are secured by all present and hereafter acquired property of the company. At issuance of the loan agreement, the company concluded that the potential acceleration of amounts outstanding under the loan agreement upon an event of default included a substantial premium and met the requirement to be bifurcated and recorded as a derivative liability at fair value at inception and at the end of each quarterly reporting period. As of December 31, 2024, the fair value of this embedded derivative liability was estimated to be $24,800 and was recorded within current liabilities. The Decathlon Fixed Loan was repayable in fixed monthly payments, which generally aggregate to $960,000 that was paid in 2023, $2,220,000 payable in 2024, $2,580,000 payable in 2025, $2,760,000 payable in 2026, and $3,480,000 payable in 2027 to the maturity date. All outstanding advances and interest under the loan agreement were scheduled to be due at maturity on June 1, 2027, unless accelerated upon a change of control or the occurrence of other events of default. Interest accrued on the amounts advanced pursuant to the loan agreement at such rate as is necessary to generate an amount equal to the minimum interest, which was defined in the loan agreement as the following multiple of the advanced amount depending on the period during which all amounts due under the loan agreement were paid. I, 0.25 times if on or before 12 months after the effective date as defined in the loan agreement. E6, 0.35 times if after 12 months and on or before 24 months after the effective date. I6, 0.50 times if after 24 months and on or before 36 months after the effective date, and 0.60 times if after 36 months after the effective date. The company could, at its option, prepay the advances and accrued but unpaid interest from time to time without penalty or premium, other than payment of the minimum interest, as defined in the loan agreement. The company incurred an aggregate of $348,065 in debt issuance costs that were recorded as a discount and were amortized using the effective interest method over the life of the Decathlon Fixed Loan using an effective interest rate of 21%. At December 31, 2024, the combined loan and accrued interest balance was $6,580,000 $586,325, and the unamortized debt issuance costs balance was $173,193. As of March 3, 2025, the combined loan and accrued interest balance, net of unamortized debt issuance costs, was $6,435,999, and the aggregate balance, together with accrued principal and interest, remaining under the loan agreement, was $6,740,516. However, the parties to the loan agreement agreed to a reduced aggregate repayment amount of $6,229,875 if voluntarily repaid early in full. On March 3, 2025, the company repaid the remaining balance of this loan in full, using a portion of the proceeds from the first tranche of the securities offering, which occurred on February 27, 2025. See Note 11, Equity, for further details. As a result of this complete repayment, the Decathlon loan agreement has been terminated, together with other agreements and instruments related thereto, and no further monthly or other payments or remuneration of any kind shall be paid or be payable following the termination of this loan agreement, and no early termination penalties or prepayment premium were incurred by the company in connection with the termination of this loan agreement. The company recorded a gain on extinguishment of debt of $230,924 in connection with the repayment of the loan, which represents the difference between A, the reduced aggregate repayment amount, and B, the carrying amount of the loan at the repayment date, which included the outstanding principal and interest balance, plus the fair value of the embedded derivative liability, and less unamortized debt issuance costs. The company recorded interest expense of $232,866 and $1,505,063 for the years ended December 31, 2025 and 2024, respectively. SUNation INUI long-term note and earnout. In connection with the SUNation INUI acquisition, on November 9, 2022, the company issued a $5,486,000 long-term promissory note. The long-term note was unsecured and matured on November 9, 2025. It carried an annual interest rate of 4% until the first anniversary of issuance, then 8% thereafter, until the long-term note was paid in full. Interest was due annually on each December 31st. The company was unable to make the second and third interest payments, totaling $250,703 and $460,194 due on December 31st, 2023 and 2024, respectively. The company was required to make a principal payment of $2,740,000 on November 9, 2024. The company was not permitted to make any payments under the long-term note unless Decathlon had provided prior written consent to such payment pursuant to the loan agreement. Pursuant to that certain subordination letter, dated May 31, 2023, each holder of the long-term note had subordinated all payments under the long-term note to the obligations owed to Decathlon under the loan agreement, the Decathlon obligations, and had agreed that, until the Decathlon obligations have been paid in full, any payment under the long-term note was subject to Decathlon's prior written consent. As the debt was part of the SUNation INUI purchase price allocation, the company assessed the fair market value of the debt instrument at $4,830,533 at the asset acquisition date, a non-recurring Level 3 fair value input. The company accretes the value of the debt over its life at a discount rate of approximately 11.2%. The long-term note may be prepaid at the company's option at any time without penalty. On March 13, 2025, the company paid the previously unpaid interest totaling $710,897 after the Decathlon debt was paid in full. As noted above, the company paid the Decathlon debt in full on March 3, 2025, and no longer had to receive written consent to make these payments. On April 10, 2025, the long-term note was amended and restated as follows. The principal amount of $5,486,000 previously due and payable under the original long-term note, together with all accrued and unpaid interest owing thereunder, shall be due and payable on May 1, 2028, the maturity date, and such amended long-term note is now a senior secured instrument. The total balance of the amended long-term note on April 10, 2025 was $5,605,436, and interest accrues at 8% per annum. Principal and interest payments under the amended long-term note shall be payable monthly on the first day of each month, commencing with June 1, 2025, for 36 consecutive months thereafter, pursuant to the terms thereunder. The amended long-term note represented a modification under ASC 470-50, as the original loan agreement and amended loan agreement are not substantially different. The company applied modification accounting to the amendment of the long-term note and recorded $38,613 of debt issuance costs as part of the discount on the amended long-term note. The amended long-term note includes optional and mandatory prepayment provisions, including required partial or full repayment in connection with specified capital raises. The amended long-term note is a senior secured instrument pursuant to a pledge agreement and includes customary default provisions and acceleration clauses. The balance of the long-term note, net of discount, recorded at December 31, 2025 and 2024 was $5,221,288 and $6,076,978, respectively. Interest and accretion expense related to the notes totaled $533,879 and $577,262 for the years ended December 31, 2025 and 2024, respectively. On April 10, 2025, the company agreed to amend the terms of the unearned 2024 earnout by entering into the Senior Secured Contingent Note instrument, Contingent Note. Pursuant to the terms of the Contingent Note, the unearned 2024 earnout was rescheduled and shall be based on the earnout terms set forth therein pursuant to the financial conditions and terms covering each of fiscal years 2024 and 2025, and if attained, shall be payable in fiscal year 2026, which payment is further conditioned on the continued employment of the holders at the time of such earnout payment trigger date. The maximum amount due under the earnout liability is $2,500,000, payable to the holders in the form of the contingent note, issuable on the earnout payment trigger date. Interest accrues on the contingent note commencing the month after issuance at a rate of 8% per annum, payable in arrears, and repayments of principal are due in 24 equal monthly installments, commencing the month after issuance. The earnout liability is accounted for under ASC 710 as a deferred compensation arrangement and is accreted to $2,303,182 over the requisite service period, as it is probable the financial conditions will be attained. The earnout liability represents the present value of the expected future cash flows as of the eligibility date of May 5, 2026. The balance of the earnout liability at December 31, 2025 was $1,535,454. Compensation expense related to the earnout liability during 2025 totaled $1,535,454 and is recorded in selling, general, and administrative expenses. As noted in Note 14, Fair Value Measurements, the company had a remaining earnout consideration accrual balance of $2,500,000 at December 31, 2024, related to the SUNation Energy acquisition earned 2023 earnout. During 2025, the company paid the balance to satisfy the outstanding liability of the earned 2023 earnout in full. Conduit Capital Bridge Loan. On July 22, 2024, the company obtained bridge loan financing for working capital purposes from Conduit Capital U.S. Holdings LLC, a conduit, an unaffiliated lender, the original Conduit note. On such date, Conduit loaned the principal sum of $500,000 to the company on an original issue OID basis of 20%, and accordingly, Conduit advanced $400,000 to the company, the initial Conduit loan. The loans due to Conduit accrued interest on the unpaid principal amount, without deduction for the OID, at an annual rate of 20%, provided that payment in full on the Conduit maturity date, as defined below, would satisfy the interest accrual on the loans from initial issuance to the Conduit maturity date. All such loans were secured by a pledge of all of the company's assets. As a condition to such loans, the company agreed to cause the nomination of a designee of Conduit for election to its board of directors. The loans due to conduit will become due on July 21, 2025, the conduit maturity date. In accordance with the terms of the loan agreements with conduit, if the company consummates one or more equity offerings prior to the conduit maturity date in which it derives aggregate gross proceeds of at least $3.15 million, it will be required to repay the unpaid principal balance of the initial conduit loan, including the OID, simultaneous with the closings of such offerings. Further, if the company consummates one or more equity offerings prior to the conduit maturity date in which it derives aggregate gross proceeds of at least $4.4 million, the company will be required to repay the entire unpaid principal amount of all loans due to conduit, including the OID, simultaneous with the closings of such offerings. At issuance of the original conduit note, the company concluded that the potential acceleration of amounts outstanding under the loan agreements with conduit upon an event of default, or if the company consummates one or more equity offerings meeting certain criteria, as noted above, included a substantial premium and met the requirement to be bifurcated and recorded as a derivative liability at fair value at inception and revalued at the end of each quarterly reporting period. The company determined the initial fair value of this embedded derivative liability to be $8,080 and recorded a corresponding debt discount. As of December 31, 2024, the fair value of this embedded derivative liability was estimated to be $28,360 and was recorded within current liabilities. For the year ended December 31, 2024, the company recorded a loss of $19,776 from the change in fair value of the derivative liability, which is included in other expense income net in the consolidated statements of operations. The company incurred Dow's $18,150 in debt issuance costs in connection with the initial conduit loan that were recorded as a discount and initially amortized using the effective interest method over the life of the initial conduit loan, along with the OID of $100,000 and initial fair value of the embedded derivative liability using an effective interest rate of approximately 29.1%. On September 9, 2024, the company and conduit entered into an amended and restated convertible secured note, the first amended conduit note, which amended the original conduit note, which provided for an additional principal advance of $120,000, the second conduit advance. The first amended conduit note also provides that conduit may convert all or any portion of the second conduit advance and all accrued but unpaid interest thereon into a number of shares, the conduit note conversion shares, of the company's common stock, calculated as the total dollar amount to be converted, divided by $22.50, 0.45 times, prior to the reverse stock splits, the conversion price. The company analyzed the changes made in the first amended conduit note under ASC 470 to determine if extinguishment accounting was applicable. Under ASC 470, 50-2010, a modification or an exchange that adds or eliminates a substantive conversion option as of the conversion date is always considered substantial and requires extinguishment accounting. Since the first amended conduit note added a substantive conversion option, extinguishment accounting is applicable. In accordance with the extinguishment accounting guidance, the company recorded a loss on extinguishment of $35,657, which represents the difference between a. the fair value of the modified loans due to conduit, less the net cash proceeds received from the second conduit advance, and b. the carrying amount of the loans due to conduit immediately prior to the second conduit advance. On September 23, 2024, the company and conduit entered into a further amended and restated convertible secured credit note, the second amended conduit note, which amends and restates the first amended conduit note. Under the terms of the second amended conduit note, conduit loaned an additional principal sum of $380,000 to the company, the third conduit advance, on an OID basis of 20%. Additionally, pursuant to the second amended conduit note, conduit was granted a demand registration right, which is in addition to the piggyback registration rights set forth in the first amended conduit note, which registration rights are inclusive of all convertible shares issuable for the second conduit advance and third conduit advance if converted. However, all out-of-pocket costs and expenses incurred in connection with this demand registration right shall borne by conduit. The third conduit advance, together with all accrued but unpaid interest thereon, are convertible into shares of common stock at the conversion price. The second amended conduit note represented a modification under ASC 470-50 as the first amended conduit note, and the second amended conduit note are not substantially different. A new effective interest rate of approximately 22.9% was established following the third conduit advance, based on the carrying value of the revised cash flows. Notwithstanding anything to the contrary as set forth in the conduit note or any tranche or amendment related thereto, in no event shall the OID, together with interest payable under the conduit note or such other documents related thereto, exceed an aggregate of 20% on the then outstanding principal sum, except in the event of a default, which shall include an additional 5% on the then outstanding principal sum. At December 31, 2024, the loan balance was $1 million, and the unamortized debt issuance costs balance was $119,389. As of February 28, 2025, the loan balance, net of unamortized debt issuance costs, was $913,924, and the aggregate loan balance was $1 million. On February 28, 2025, the company paid the $1 million total loan balance to Conduit, as the company had gross proceeds from equity offerings in excess of $4.4 million. See Note 11, Equity, for further details. As a result of this complete repayment, the conduit note has been terminated, and no further principal, interest, or accrual thereunder remain following the repayment and related termination of the conduit loan agreements. The company recorded a loss on extinguishment of debt of $57,716 in connection with the repayment of the loan, which represents the difference between A, the aggregate repayment amount, and B, the carrying amount of the loan at the repayment date, which included the outstanding principal balance plus the fair value of the embedded derivative liability and less unamortized debt issuance costs. The company recorded interest and accretion expense of $33,312 and $73,689 for the years ended December 31, 2025 and 2024 respectively. MBB Energy Bridge Loan. On July 22, 2024, the company obtained bridge loan financing for working capital purposes from MBB, an affiliate of the company, the original MBB note. On such date, MBB loaned the principal sum of $500,000 to the company on an OID basis of 20%, and accordingly, MBB advanced the sum of $400,000 to the company, the initial MBB loan. The loans due to MBB accrued interest on the unpaid principal amount, without deduction for the OID, at an annual rate of 20%, provided that payment in full on the MBB maturity date, as defined below, satisfied the interest accrual on the loans from initial issuance to the conduit maturity date. All such loans were secured by a pledge of all of the company's assets. MBB has granted Conduit the exclusive right to enforce MBB's loans on MBB's behalf. The loans due to MBB will become due on July 21, 2025, the MBB maturity date. In accordance with the terms of the loan agreements with MBB, if the company consummates one or more equity offerings prior to the MBB maturity date, in which it derives aggregate gross proceeds of at least $3.15 million, it will be required to repay the unpaid principal balance of the initial MBB loan, including the OID, simultaneous with the closings of such offerings are. Further, if the company consummates one or more equity offerings prior to the MBB maturity date, in which the company derives aggregate gross proceeds of at least $4.4 million, the company will be required to repay the entire unpaid principal amount of all loans due to MBB, including the OID, simultaneous with the closings of such offerings. At issuance of the original MBB note, the company concluded that the potential acceleration of amounts outstanding under the loan agreements with MBB upon an event of default, or if the company consummates one or more equity offerings meeting certain criteria, as noted above, included a substantial premium and met the requirement to be bifurcated and recorded as a derivative liability at fair value at inception and at the end of each quarterly reporting period. The company determined the initial fair value of this embedded derivative liability to be $8,080 and recorded a corresponding debt discount. As of December 31, 2024, the fair value of this embedded derivative liability was estimated to be $29,121 and was recorded within current liabilities. For the year ended December 31st, 2024, the company recorded a loss of $21,041 from the change in fair value of the derivative liability, which is included in other expense income net in the consolidated statements of operations and comprehensive loss. The OID of $100,000 was recorded as a discount and initially amortized using the effective interest method over the life of the initial MBB loan, along with the initial fair value of the embedded derivative liability using an effective interest rate of approximately 24.3%. On August 16, 2024, MBB provided an additional principal advance of $500,000, the second MBB advance. The second MBB advance represented a modification under ASC 470-50. A new effective interest rate of approximately 24.1% was established following the second MBB advance, based on the carrying value of the revised cash flows, notwithstanding anything to the contrary as set forth in the MBB note or any tranche or amendment related thereto. In no event could the OID, together with interest payable under the MBB note or such other documents related thereto, exceed an aggregate of 20% on the then outstanding principal sum, except in the event of a default, which shall include an additional 5% on the then outstanding principal sum. At December 31st, 2024, the loan balance was $1 million, and the unamortized debt issuance costs balance was $125,391. As of February 28, 2025, the loan balance, net of unamortized debt issuance costs, was $909,509, and the aggregate loan balance was $1 million. On February 28, 2025, the company repaid the $1 million total loan balance to MBB, as the company had gross proceeds from equity offerings in excess of $4.4 million. See Note 11, Equity, for further details. As a result of this complete repayment, the MBB note has been terminated, and no further principal, interest, or accrual thereunder remain following the repayment and related termination of the MBB loan agreements. The company recorded a loss on extinguishment of debt of $61,370 in connection with the repayment of the loan, which represents the difference between A, the aggregate repayment amount, and B, the carrying amount of the loan at the repayment date, which included the outstanding principal balance, plus the fair value of the embedded derivative liability and less unamortized debt issuance costs. The company recorded interest and accretion expense of $34,900 and $82,689 for the years ended December 31st, 2025 and 2024, respectively. The company obtains various equipment loan agreements through SUNation NY. These loans are secured by machinery and equipment and expire at various dates through August 2029, with interest rates ranging from 4.5 to 9.7% per annum. The balance for the equipment loans recorded at December 31, 2025 and 2024 was $175,370 and $238,266, respectively. Interest expense was $16,885 and $24,332 for the years ended December 31, 2025 and 2024, respectively. Through the SUNation NY acquisition, the company acquired a promissory note with a former shareholder and member of SUNation NY through a buyout agreement. The promissory note includes monthly payments of principal and interest at an annual rate of 3.25%. The promissory note matures on March 1, 2031. On January 30, 2026, the company settled the outstanding debt for $800,000. See further discussion within Note 16, Subsequent Events. The balance for the promissory note recorded at December 31, 2025 and 2024 was $1,154,059 and $1,409,313, respectively. Interest expense was $42,023 and $50,174 for the years ended December 31, 2025 and 2024, respectively. The above table does not reflect the debt payoff that took place subsequent to year-end. See Note 16, Subsequent Events, for further discussion. In the ordinary course of business, the company is exposed to legal actions and claims and incurs costs to defend against these actions and claims. Company management is not aware of any outstanding or pending legal actions or claims that could materially affect the company's financial position or results of operations. At December 31st, 2024, the company accrued $1,300,000 for loss contingencies related to certain prior securities issuances. During 2025, the company settled this obligation by issuing 6,068 shares, 1,213,656 shares prior to the April reverse stock split of common stock and payment of $398,529 in cash. There was no remaining accrual balance at December 31, 2025. Related party receivables. The company has provided advances to employees, resulting in a balance as of December 31, 2025 and 2024 of $21,412 and $23,471, respectively. The company leases its offices in Hawaii from a company owned by the prior owner of HEC, of whom is still an employee. The company leased its New York office from a company owned by the prior owners of SUNation NY, one of whom is an officer and another the chief executive officer and director of the company, until September 12, 2024, when the building and related lease was sold to a third party. See further information regarding these leases within Note 5, Leases. As of December 31st, 2025, the company only has outstanding related party debt under the SUNation NY long-term note and the revolving credit agreement. The MBB note was paid in full during the first quarter of 2025. See further information regarding this debt within Note 8, Commitments and Contingencies. 2022 Equity Incentive Plan. On January 24, 2022, the Board of Directors adopted, and on March 16, 2022, the company's shareholders approved the company's 2022 Equity Incentive Plan, the 2022 Plan, which became effective on March 28, 2022. The 2022 Plan authorizes incentive awards to officers, key employees, non-employee directors, and consultants in the form of options, incentive and non-qualified, stock appreciation rights, restricted stock awards, stock unit awards, and other stock-based awards. Following amendments approved on December 7, 2022 and July 19, 2024, the 2022 Plan authorizes the issuance of up to 67 shares of common stock, 10 million, prior to the reverse stock splits. At December 31, 2025, 4 shares had been issued under the 2022 Plan. 3 shares were subject to currently outstanding unvested restricted stock units, RSUs, and 60 shares were available for future awards. RSUs granted to employees generally vest over 3 years, with 1/3 vesting each year, and RSUs granted to non-employee directors vest over 1 year. Restricted stock units. All RSUs and weighted average grant date fair value per share values have been adjusted to reflect the impact of the reverse stock splits of the common stock at ratios of 1:200 that became effective on April 21, 2025, 1:50 that became effective on October 17, 2024, and 1:15 that became effective on June 12, 2024. See Note 1, Nature of Operations, for further details. Compensation expense. Share-based compensation expense is recognized based on the fair value of awards granted over the vesting period of the award. Share-based compensation expense recognized for 2025 and 2024 was $85,226 and $29,002 respectively. Unrecognized compensation expense related to outstanding RSUs was $11,467 at December 31, 2025, and is expected to be recognized over a weighted average period of 0.6 years. Share-based compensation expense is recorded as a part of selling, general, and administrative expenses. Employee Stock Purchase Plan. On December 7, 2022, the company's shareholders approved an Employee Stock Purchase Plan. On September 2, 2022, the company's shareholders are able to acquire shares of common stock at a purchase price determined by the Board of Directors or Compensation Committee prior to the start of each 6-month plan phase, which price may not be less than 85% of the fair market value of the lower of the value on the first day or the last day of the phase, or the value on the last day of the phase. The ESPP is considered compensatory under current Internal Revenue Service rules. At December 31, 2025, 2 shares remained available for purchase under the ESPP. Series A preferred stock. In June 2021, the company entered into a stock purchase agreement to issue Series A preferred stock. The company's outstanding Series A preferred stock contained anti-dilution provisions that would increase the number of shares issuable upon conversion and lower the conversion price of the Series A preferred stock if the company issues equity securities at a price less than the current conversion price of the Series A preferred stock at the time of such issuance. In February 2024, the company entered into a limited waiver and amendment waiver, and the investors agreed to a floor of $105, 0.14 cents prior to the reverse stock splits, with respect to the adjustment set forth for the conversion price, and to waive future anti-dilution protection with respect to 50% of the shares of preferred stock held by such purchasers as of the date of the waiver. The company determined that the waiver resulted in an extinguishment of the Series A preferred stock. As a result, the Series A preferred stock was revalued immediately after the waiver in February 2024. The difference between the previous carrying amount and the fair value of $751,125 was recognized as a deemed dividend in the 3 months ended March 31, 2024, that reduced additional paid-in capital, APIC, and income available to common shareholders in calculating earnings per share. In addition, management evaluated the Series A preferred stock after the modifications and determined that they should be reclassified to mezzanine equity under ASC 480-10-S99 as a result of the company not having sufficient authorized and unissued shares to settle a conversion to common stock. On July 19, 2024, the shareholders of the company approved an amendment to the company's Fourth Amended and Restated Articles of Incorporation, the Articles of Incorporation, to increase the number of authorized shares of common stock, and as a result, the company had sufficient authorized and unissued shares to settle a conversion to common stock. Accordingly, the Series A preferred stock was reclassified to permanent equity at the date of the event that caused the reclassification. See description of Series C preferred stock issued in exchange for the then outstanding Series A preferred stock and PIPE warrants. On September 9, 2024, as a result of the issuance of the first amended conduit note, see Note 8, Commitments and Contingencies, for further details. The adjustment provisions in the Series A preferred stock were triggered and caused certain adjustments in the currently effective conversion price of the Series A preferred stock. The company recognized the effect of the down round feature triggered on September 9, 2024, as the difference between 1. The fair value of the Series A preferred stock using the pre-trigger conversion price, and 2. The fair value of the Series A preferred stock using the reduced conversion price. The value of the effect of the down round feature of $3,464,426 was recognized as a deemed dividend in the year ended December 31, 2024, that reduced APIC and income available to common shareholders in calculating earnings per share. In September 2021, the company entered into transactions with holders of its outstanding Series A preferred stock to issue PIPE warrants to purchase the company's common stock. The company's outstanding PIPE warrants have anti-dilution provisions that would increase the number of shares issuable upon exercise and lower the exercise price of the PIPE warrants if the company issues equity securities at a price less than the current exercise price of the PIPE warrants at the time of such issuance. Pursuant to the waiver, investors agreed to a floor of $22.50, 14 cents prior to the reverse stock splits, with respect to the anti-dilution adjustments in the warrants, and extend the term of the warrants until March 28, 2029. The PIPE warrants were valued immediately before and immediately after the modifications to calculate the $10.6 million incremental value of the modified PIPE warrants. The company considered this incremental value to be a deemed dividend that reduced income available to common shareholders in calculating earnings per share. Management evaluated the warrants after the modifications made in February 2024 and determined that they should be reclassified from equity to liability based on the guidance in ASC 815-40 and the company failing to have enough authorized and unissued shares available to settle an exercise of the contract. In accordance with ASC 815-40, the carrying value of the warrants were adjusted to fair value to an adjustment in stockholders' equity immediately prior to the reclassification. Subsequent to the reclassification, management remeasured the warrant liability to fair value and recorded the change in fair value to other income expense in the consolidated statement of operations. On July 19, 2024, the shareholders of the company approved an amendment to the Articles of Incorporation to increase the number of authorized shares of common stock, and as a result, the company had sufficient authorized and unissued shares to settle an exercise of the contract. Accordingly, management determined that the warrants should be reclassified to equity. In accordance with the guidance in ASC 815-40-35-10, management remeasured the warrant liability to fair value immediately before the reclassification and recorded the change in fair value to other income expense in the consolidated statement of operations. On September 9, 2024, as a result of the issuance of the first amended conduit note, see Note 9, Commitments and Contingencies for further details. The adjustment provisions in the warrants were triggered and caused certain adjustments in the currently effective exercise price of the warrants and a proportional increase in the amount of shares of common stock issuable under the warrants. The company recognized the effect of the down round feature triggered on September 9, 2024, as the difference between 1. The fair value of the warrants using the pre-trigger conversion price, and 2. The fair value of the warrants using the reduced conversion price. The value of the effect of the down round feature of $875,737 was recognized as a deemed dividend in the year ended December 31, 2024, that reduced income available to common shareholders in calculating earnings per share. On September 9, 2024, the company entered into a securities exchange agreement with the holders of the Series A preferred stock and PIPE warrants to cancel and retire all of the Series A preferred stock and PIPE warrants in exchange for shares of Series C convertible preferred stock of the company, the Series C preferred stock. The company determined that the exchange of the Series A preferred stock and warrants for the Series C preferred stock resulted in the extinguishment of the Series A preferred stock and warrants. As a result, the difference between the carrying amount of the Series A preferred stock and warrants and the fair value of the Series C preferred stock of $4,075, $681 was recognized as a deemed contribution in the year ended December 31, 2024, that increased API catch and income available to common shareholders in calculating earnings per share. Series C preferred stock. On September 9, 2024, the company's board of directors authorized the issuance of up to 35,000 shares of Series C preferred stock. As a result of the exchange noted above, the company issued 28,041 shares of Series C preferred stock. Each share of Series C preferred stock is convertible at any time after issuance and at the option of the holder, subject to certain beneficial ownership limitations, into a number of shares of common stock determined by dividing the stated value of such share by the conversion price. The stated value per share of Series C preferred stock is $1,000 and the conversion price per share of Series C preferred stock is $22.50, 0.45 prior to the October reverse stock split. The Series C preferred stock does not contain any of the price resets set forth in the Series A preferred stock, except in the case of stock splits, recapitalizations, and similar transactions by the company. During 2024, all 28,041 shares of Series C preferred stock were converted into 1,246,262 shares of common stock. As of December 31, 2024, there were no shares of Series C preferred stock outstanding. Series B preferred stock. On May 13, 2024, the company entered into a subscription and investment representation agreement, pursuant to which the company agreed to issue and sell one share of the company's Series B preferred stock, par value $1 per share, Series B preferred stock, for $15. The sale closed on May 14, 2024. On May 13, 2024, the company filed a certificate of designation, the Certificate of Designation, with the Secretary of State of Minnesota, effective as of May 13, 2024, designating the rights, preferences, privileges, and restrictions of the share of the Series B preferred stock. The Certificate of Designation provides that the share of Series B preferred stock has 5 billion votes and will vote together with the outstanding shares of the company's common stock as a single class exclusively with respect to equals any proposal to amend the company's articles to effect a reverse stock split of the company's common stock, the reverse stock split proposal, and equals any proposal to adopt an amendment to the articles or any other proposal to otherwise approve or ratify to increase the authorized number of shares of common stock, either by increasing the total number of authorized shares or by effecting a reverse stock split without a corresponding decrease in the number of authorized shares, the authorized shares increase proposal. The Series B preferred stock will also be entitled to vote in the election of directors, but will only have one vote to cast with respect to each director nominee. Under the certificate of designation, the outstanding share of Series B preferred stock will be canceled in whole, but not in part, at any time, if such cancellation is ordered by the company's board of directors in its sole discretion, or 2, automatically upon the approval by the company's shareholders of the reverse stock split proposal and authorized shares increase proposal at any meeting of shareholders. The holder of the share of Series B preferred stock was not entitled to any consideration upon such cancellation. The shareholders approved the reverse stock split proposal and authorized shares increase proposal on July 19, 2024, and, as a result, the share of Series B preferred stock was automatically canceled at that time. Registered direct offering. On February 5, 2024, the company entered into a securities purchase agreement with certain institutional investors for the sale by the company of 18 shares, 2,702,703 prior to the reverse stock splits of the company's common stock in a registered direct offering. The purchasers in this offering purchased, and the company sold, the shares at a purchase price per share of $55,500, $0.37 prior to the reverse stock splits. The sale closed on February 7, 2024, for aggregate gross proceeds of $1.0 million before deducting the placement agent fees and related offering expenses. At the market offering, on October 21, 2024, the company entered into an at-the-market, accumulating money or talking in the KDM offering agreement, the sales agreement, with Roth Capital Partners, LLC, the sales agent. The company has authorized the sale, at its discretion, of common stock shares in an aggregate offering amount up to $10 million under the sales agreement, pursuant to the company's effective registration statement on Form S-3, file number 333-267066, as supplemented by a prospectus supplement. During 2024, the company sold an aggregate of 2,241 shares, 448,216 shares prior to the April reverse stock split of common stock for gross proceeds of $2,457,354 under the ATM facility before deducting the placement agent fees and related offering expenses. During 2025, the company sold an aggregate of 762 shares, 152,250 shares prior to the April reverse stock split of common stock, respectively, for gross proceeds of $362,269 under the ATM facility before deducting the related offering expenses. On August 11, 2025, the company provided written notice of termination of the sales agreement to the sales agent pursuant to the terms thereunder. On August 18, 2025, the company entered into a sales agreement, the Needham Sales Agreement, with Needham & Company, LLC, Needham, or the Needham Sales Agent, with respect to an offering and sale, at any time and from time to time, of the company's common stock, the shares, in an aggregate offering amount up to $30 million under the Needham Sales Agreement. Sales of the shares, if any, will solely be made in at-the-market offerings. On November 4, 2025, the company provided formal written notice to Needham of the termination of the sales agreement entered into with Needham. No sales or offering of shares were made thereunder since entry into this sales agreement. Series D preferred stock. On February 26, 2025, the company entered into a consent and waiver agreement to the loan agreement with Conduit. In accordance therewith, the company issued one share of Series D preferred stock to Conduit as further collateral security for the Conduit loan. The Series D preferred stock was issued in accordance with a certificate of designation of preferences, rights, and limitations filed with the state of Delaware on February 27, 2025. In connection with the issuance of the share of Series D preferred stock, Conduit granted an irrevocable proxy to the company to vote such share on an as-converted basis as a single class with the holders of the company's common stock. upon full payment of the conduit loan and following the April 2025 special meeting of shareholders, the Series D preferred stock share was returned to the company and was canceled. February 2025 offering. On February 27, 2025, the company entered into a securities purchase agreement, the purchase agreement, with certain institutional investors in a registered direct offering, the offering, for a multi-tranche offering in which Roth Capital Partners LLC, Roth, acted as the placement agent pursuant to the terms of a placement agent agreement of same date. The first tranche closing involved the purchase and sale of an aggregate of $15 million in securities in a first closing consisting of 9,825 shares, 1,965,000 shares prior to the April reverse stock split of common stock, and pre-funded warrants to purchase up to 55,392 shares, 11,078,480 shares prior to the April reverse stock split of common stock, the pre-funded warrants, and, subject to shareholder approval, an aggregate of $5 million in securities in a second closing consisting of Fahrenheit, 21,739 shares, 4,347,826 shares prior to the April reverse stock split of common stock or pre-funded warrants, Series A warrants to purchase up to 86,957 shares, 17,391,306 shares prior to the April reverse stock split of common stock, the Series A warrants, and Series B warrants to purchase up to 86,957 shares, 17,391,306 shares prior to the April reverse stock split of common stock, the Series B warrants, at a purchase price of $230.00 per share, $1.15 prior to the April reverse stock split, and accompanying warrants, or $229.80 per pre-funded warrant, $1.1490 prior to the April reverse stock split, and accompanying warrants. The Series A warrants had an exercise price of $345 per share, $1.725 per share prior to the April reverse stock split, subject to standard adjustments for dividends, splits, and similar events. A one-time adjustment on the date of issuance, as described in the warrants, subject to a floor price described therein, and also subject to adjustment upon a dilutive issuance, as described in the warrants, subject to a floor price described therein. The Series B warrants had an exercise price of $575 per share, $2.875 per share prior to the April reverse stock split, subject to standard adjustments for dividends, splits, and similar events. A one-time adjustment on the date of issuance, as described in the warrants, all of which were subject to a floor price described therein, and also subject to adjustment upon a dilutive issuance, as described in the warrants, subject to a floor price described therein. The Series B warrants could also be exercised on an alternative cashless basis, pursuant to which the holder may exchange each warrant for 3 shares of common stock. The Series A warrants and Series B warrants were issuable at the second tranche closing and were exercisable immediately after issuance and carried a term of exercise equal to 5 years from the date of issuance. The first tranche closing of the offering occurred on February 27, 2025. The company determined that the second closing of the offering represents a firm commitment and a contingent forward contract to issue and sell additional shares of common stock or pre-funded warrants, and the Series A warrants and Series B warrants conditioned following receipt of approval by the company's stockholders for the issuance of the Series A warrants, Series B warrants, and the shares of common stock underlying such warrants. The company determined that the contingent forward contract is a freestanding financial instrument that does not meet the requirements for equity classification due to certain settlement provisions that fail the indexation guidance in ASC 815-40 and meets the definition of a derivative. As a result, the contingent forward contract was recorded as a liability initially at its fair value on the date of issuance and will be subsequently remeasured to fair value on each balance sheet date until the underlying instruments are issued and sold in the second tranche closing of the offering. The company determined the initial fair value of the contingent forward contract to be $5,515,525. The shares of common stock and pre-funded warrants issued and sold in the first closing of the offering were classified as a component of permanent equity and recorded at the issuance date using a relative fair value allocation method of the remaining proceeds of the offering after recording the contingent forward contract at its fair value on the date of issuance. The pre-funded warrants were equity classified because they were freestanding financial instruments that were legally detachable and separately exercisable from the equity instruments, were immediately exercisable, did not embody an obligation for the company to repurchase its shares, and permitted the holders to receive a fixed number of shares of common stock upon exercise. In addition, such pre-funded warrants did not provide any guarantee of value or return. As of March 31st, 2025, all 55,392 pre-funded warrants, 11,078,480 prior to the April reverse stock split, issued and sold in the first closing of the offering, had been exercised in exchange for the issuance of 55,392 shares, 11,078,480 shares prior to the April reverse stock split of the company's common stock. On April 3, 2025, the company received the necessary approval by the company's stockholders in a specially called stockholder meeting to approve the issuance of the Series A warrants, Series B warrants, and the shares of common stock underlying such warrants, in addition to other matters. On April 7, 2025, the company closed the second tranche of its previously announced securities purchase agreement, dated February 27, 2025, with certain institutional investors for the purchase and sale of 21,720 shares, 4,347,826 shares prior to the April 2025 reverse stock split of the company's common stock, or common stock equivalents in lieu thereof, Series A warrants to purchase up to an aggregate 86,957 shares, 17,391,306 shares prior to the April 2025 reverse stock split of the company's common stock, and Series B warrants to purchase up to an aggregate 86,957 shares, 17,391,306 shares prior to the April 2025 reverse stock split of the company's common stock at an effective purchase price of $230 per share, $1.15 per share prior to the April 2025 reverse stock split, or common stock equivalents in lieu thereof, and associated warrants in a registered direct offering, which was priced at the market under applicable NASDAQ rules for the second tranche gross proceeds of $5 million. Together with the approximately $15 million in gross proceeds from the previously announced first tranche closing completed on February 27, 2025, the company raised approximately $20.0 million in aggregate gross proceeds from the offering before deducting placement agent fees and other offering expenses payable by the company. The company de-recognized the contingent forward contract liability representing the firm commitment for the second closing on April 7, 2025, the date of the second closing. The company determined the fair value of the contingent forward contract liability to be $4,399,054 immediately prior to the second closing. During 2025, the company recorded a gain of $899,080 from the change in fair value of the contingent forward contract, which is included in other expense income net in the consolidated statements of operations. The Series A warrants and Series B warrants did not meet the requirements for equity classification due to certain settlement provisions that failed the indexation guidance in ASC 815-4. As a result, the Series A warrants and Series B warrants were recorded as a liability initially at fair value on the date of issuance and were subsequently remeasured to fair value at each balance sheet date until exercised. During the second quarter for 2025, the Series B warrants to purchase the company's common stock were fully exercised in exchange for the issuance of 3,260,870 shares, 652,173,983 shares prior to the April reverse stock split of the company's common stock and are no longer outstanding. The company determined the fair value of the Series B warrants to be $8,637, $203 immediately prior to exercise and recorded a loss of $8,025,504 from the change in fair value of the Series B warrants, which is included in other expense income net in the consolidated statements of operations. On June 26, 2025, the company and holders of Series A warrants to purchase the company's common stock mutually agreed to terminate and cancel the Series A warrants for an aggregate payment to the Series A warrant holders of $267,391. The company determined the fair value of the Series A warrants to be $761,851 immediately prior to exercise and recorded a gain of $494,460 from the change in fair value of the Series A warrants, which is included in other expense income net in the condensed consolidated statements of operations. The shares of common stock issued and sold in the second closing and upon exercise of the Series B warrants are classified as a component of permanent equity and recorded at the issuance date fair value. Pursuant to the PAA between the company and Roth, the company engaged Roth to act as the company's exclusive placement agent in connection with the offering. The company agreed to pay the placement agent a cash fee of 7.5% of the gross proceeds the company receives under the purchase agreement. As of December 31st, 2025, the company had incurred an aggregate of $2,128,038 in placement agent fees and related offering expenses, of which $1,136,532 were allocated to the contingent forward contract and Series A and Series B warrants and expensed in financing fees, and $991,506 were allocated to the shares of common stock and pre-funded warrants issued and sold in the first closing of the offering and recorded as a reduction to ANI RPIC in stockholders' equity. The company assesses available positive and negative evidence to estimate if sufficient future taxable income will be generated to use the existing deferred tax assets. A significant piece of objective negative evidence evaluated was the cumulative loss incurred over the 3-year period ended December 31, 2025. This objective evidence limits the ability to consider other subjective evidence, such as the projections for future growth. On the basis of this evaluation, as of December 31st, 2025, a valuation allowance of $11,882,160 has been recorded to reflect the portion of the deferred tax asset that is more likely to not be realized. The valuation allowance increased by $1,634,028 from December 31st, 2024 to December 31st, 2025. The company continues to reassess the ability to realize the valuation allowance, and if future evidence allows for a partial or full release of the valuation allowance, a tax benefit will be recorded accordingly. As of December 31st, 2025, the company had gross federal, state, and foreign net operating loss carryforwards of $27,821,873, $17,897,782, and $7,642,027. The federal net operating loss carryforwards have carryforward periods of 20 years, or that are indefinite, and begin to expire in 2029. The state net operating loss carryforwards have carryforward periods of 20 years, or that are indefinite and begin to expire in 2027. The foreign net operating loss carryforwards are indefinite. Section 382 of the Internal Revenue Code limits the utilization of U.S. net operating loss carryforwards and other tax attributes following a change of ownership or failure of continuity of business. Based on our analysis under Section 382, we believe that certain tax attributes will be subject to a limitation and will not be available for future periods. Management will continue to evaluate the limitation under Section 382 and does not expect a material impact because of the valuation allowance against the net deferred tax assets. At December 31, 2025, the company has an estimated federal research and development credit carry forward of approximately $220,000 and a state research and development credit carry forward of approximately $193,000. The utilization of these credits may be limited under the provisions of Section 383 of the Internal Revenue Code and similar state statutes. Section 383 governs the utilization of tax attribute carryforwards, such as the research and development credit, in the event of a change in control of the company, such as that which occurred as of March 28, 2022. Credits not used to reduce taxes are available to be carried forward. The company assesses uncertain tax positions in accordance with ASC 740. Under this method, The company must recognize the tax benefit from an uncertain tax position only if it is more likely than not that the tax position will be sustained on examination by the taxing authorities based on the technical merits of the position. The tax benefits recognized in the financial statements from these uncertain tax positions are measured based on the largest benefit that has a greater than 50% likelihood of being realized upon ultimate resolution. The company's practice is to recognize interest and penalties related to income tax matters in income tax expense. Included in the balance of uncertain tax positions at December 31st, 2025, are 32,665 of tax benefits that, if recognized, would affect the tax rate. The company's income tax liability accounts included accruals for interest and penalties of zero at December 31st, 2025. The company's 2025 income tax expense decreased by zero due to net decreases for accrued interest and penalties. The company is subject to taxation by the United States, foreign and state and local jurisdictions. In general, the company's tax years 2019 through 2025 remain open to assessment. On July 4, 2025, the One Big Beautiful Bill Act was enacted into law. The legislation includes several changes to federal tax law, including permanent extension of certain expiring Tax Cuts and Jobs Act provisions and modifications to U.S. taxation of foreign activity. Certain provisions were effective for 2025, while others will be effective for tax years beginning after December 31, 2025. The company has evaluated the impact of the legislation and incorporated the applicable tax provisions into its consolidated financial statements for the current reporting period. The company's segment structure reflects how management makes financial decisions and allocates resources. The company manages its operations based on the combined results of the residential and commercial businesses with a geographical focus. The SUNation NY segment provides solar power, battery storage, and related services to customers in New York. The Hawaii Energy Connection HEC segment provides the same products and services to residential and commercial customers in Hawaii. The company's CODM is represented by a committee that includes the company's CEO, CFO, and COO. The CODM regularly reviews discrete financial information for SUNation UY and HEC in deciding how to allocate resources and in assessing performance. Corporate and Other represents the unallocated corporate business activities and corporate shared services, which support the company's operating segments, along with operating and other expenses related to legacy CSI assets. The CODM committee evaluates performance for both reportable segments based on segment revenue, gross profit, and operating loss income before income taxes. When using these metrics, the CODM committee considers forecast to actual variances on a quarterly basis when making decisions about the allocation of operating and capital resources to each segment. The CODM committee also uses these metrics for evaluating pricing strategy to assess the performance of each segment by comparing the results of each segment with one another and in determining the compensation of certain employees. The company had no customers that comprised more than 10% of the company's consolidated revenues during either of the years ended December 31, 2025 and 2024. The estimated fair value of the contingent value rights, CVR, as of December 31, 2025 and 2024 was $0 and $312,080, respectively, as noted above. The company recorded a $36,079 gain on the fair value remeasurement of the CVRs in 2025 and a $522,257 gain on the fair value remeasurement of the CVRs in 2024. The company paid $276,001 and $856,736 in CVR distributions during 2025 and 2024, respectively. The estimated fair value of the contingent forward contract was zero as of December 31st, 2025. The estimated fair value was considered a Level 3 measurement, and the fair value of the contingent forward contract is determined using a Monte Carlo simulation. As a result of the fair value remeasurement, the company recorded a remeasurement gain of $899,080 in 2025. See Note 11, Equity, for further information. The estimated fair value of earnout consideration related to the acquisition of SUNation New York as of December 31st, 2024 was $2,500,000, respectively. the company paid $2,500,000 against the earnout consideration during 2025 related to the first earnout period. The estimated fair value was considered a Level 2 measurement at December 31st, 2024, because the earnout amounts had been established and there was no longer a reliance on unobservable inputs. As a result of the fair value remeasurement, the company recorded a remeasurement gain of $1 million during the year ended December 31st, 2024. As noted in Note 11, the PIPE warrants were classified as a liability during the first quarter of 2024, resulting in a $10,592,202 reclassification from equity. During the third quarter of 2024, the PIPE warrants met equity classification requirements upon the shareholder approval of an increase in authorized outstanding shares and reclassified the fair value liability totaling $11,242,254 back to equity. As discussed in Note 11, Equity, during the second quarter of 2025, the company issued Series A and Series B warrants. The estimated fair value is considered a Level 3 measurement, and the fair value of the warrant liability is determined using a Monte Carlo simulation to model future movement of the stock price. As a result of the fair value remeasurement, the company recorded a remeasurement loss of $7,531,044 and $974,823 during the years ended December 31, 2025 and 2024, respectively. The estimated fair value of the embedded derivative liability was $82,281 as of December 31st, 2024. As noted in Note 8, Commitments and Contingencies, the company repaid the debt associated with the embedded derivative liabilities, and the embedded derivative balance was included within the debt extinguishment. The estimated fair value is considered a Level 3 measurement, and the fair value of the embedded derivative liability is determined based on a comparison of the present value of cash flows with and without the embedded derivative. This analysis includes management estimates of the likelihood of events of prepayment and default on the Decathlon, MBB, and Conduit loans. The fair value remeasurement related to the SUNation NY earnout was recorded within operating expenses. The other fair value remeasurements noted above were recorded within other income, expense, in the consolidated statements of operations. We record transfers between levels of the fair value hierarchy, if necessary, at the end of the reporting period. There were no transfers between levels during the year ended December 31, 2025. The company's financial statements as of December 31, 2025 have been prepared in accordance with GAAP applicable to a going concern, which contemplates the realization of assets and liquidation of liabilities in the normal course of business. Based on the company's current financial position and the company's forecasted future cash flows for 12 months beyond the date of issuance of these financial statements, substantial doubt exists around the company's ability to continue as a going concern for a reasonable period of time. As noted in Note 11, Equity, and Note 8, Commitments and Contingencies, the company raised capital and satisfied certain outstanding debt obligations during 2025. However, there remains uncertainty related to our future cash flows, as it relies on the ability to generate enough cash flow from its operating segments to cover the company's corporate overhead costs. In order to continue as a going concern, the company will need additional capital resources. Management plans to raise capital through sources that may include public or private equity offerings, debt financings, and/or strategic alliances. However, management cannot provide any assurances that the company will be successful in accomplishing any of its plans. These financial statements do not include any adjustments related to the recoverability and classification of assets or the amounts and classification of liabilities that might be necessary should the company be unable to continue as a going concern. The company has evaluated subsequent events through the date of this filing. As discussed in Note 8, Commitments and Contingencies, the company acquired a promissory note with a former shareholder and member of SUNation NY. On January 30th, 2026, the company reached agreement to eliminate this promissory note. Prior to reaching this settlement, the promissory note carried remaining principal balance of approximately $1.1 million. To eliminate the long-term promissory note, significantly reduce this remaining multi-year obligation and improve financial flexibility. The company negotiated a one-time lump sum settlement payment of $800,000, which payment was made on January 30th, 2026. In connection with the elimination of the long-term promissory note, the company utilized its existing $1 million revolver with MBB. Prior to drawing on this facility in January 2026, no amounts had been drawn on the revolver. Under the supervision and with the participation of our management, including our Chief Executive Officer, CEO, and Chief Financial Officer, CFO, we evaluated the effectiveness of the design and operation of our disclosure controls and procedures, as defined in Rule 13A-15E and 15D-15E, under the Securities Exchange Act of 1934, the Exchange Act, as of December 31st, 2025. Based on that evaluation, management concluded that the company's disclosure controls and procedures were not effective because of material weaknesses in the company's internal control over financial reporting described below. The company's management is responsible for establishing and maintaining adequate internal control over financial reporting, as that term is defined in Rule 13A-15F and 15D-15F of the Exchange Act. Under the supervision and with the participation of the company's management, including the CEO and CFO, the company conducted an evaluation of the effectiveness of the company's internal control over financial reporting as of December 31st, 2025, based on Internal Control Integrated Framework 2013, issued by the Committee of Sponsoring Organizations of the Treadway Commission, the framework. Based on that evaluation, management concluded that the company's internal control over financial reporting was not effective as of December 31st, 2025, due to material weaknesses in the company's internal control over financial reporting. A material weakness is defined as a deficiency or combination of deficiencies in internal control over financial reporting, such that there is a reasonable possibility that a material misstatement of our annual or interim financial statements will not be prevented or detected on a timely basis. The following material weaknesses are identified. In prior years, we identified material weaknesses in our internal control over financial reporting, and these material weaknesses persisted throughout the year ended December 31st, 2025, due to our limited accounting and finance resources, which resulted in inappropriate preparation, review, and maintenance of documentation and information that is critical to the design and consistent execution of internal controls. In the current year, we identified a material weakness as a result of an aggregation of control deficiencies in our information technology, all IT controls, specifically around user access review, provisioning, change management, and cybersecurity of our accounting and customer resource management systems. These material weaknesses could result in a misstatement of account balances or disclosures that would result in a material misstatement to the annual or interim financial statements that would not be prevented or detected. To address the material weaknesses in our internal control over financial reporting, the company is in the process of formalizing a remediation plan that will address our limited resources and also includes implementing a new enterprise resource planning (ERP) system, which provides the necessary control environment to help mitigate the potential for misstatements in financial reporting, including but not limited to segregation of duties, user permission and access controls, and automated processes. Additionally, we will work to design and implement formal policies and processes around our IT systems. While we believe that these efforts will improve our internal control over financial reporting, the design and implementation of our remediation is ongoing and will require validation and testing of the design and operating effectiveness of our internal controls over a sustained period of time. We will not be able to conclude whether the steps we are taking will fully remediate the material weaknesses in our internal control over financial reporting until we have completed our remediation efforts and subsequent evaluation of their effectiveness. Until these weaknesses are remediated, we plan to continue to perform additional analyses and other procedures to ensure that our consolidated financial statements are prepared in accordance with U.S. GAAP. Because of the inherent limitations in all control systems, no evaluation of controls can provide absolute assurance that all control issues and instances of fraud, if any, will be or have been detected. These inherent limitations include the realities that judgments in decision-making can be faulty, and that breakdowns can occur because of simple error or mistake. Additionally, controls can be circumvented by the individual acts of some persons, by collusion of two or more people, or by management override of the control. The design of any system of controls also is based in part upon certain assumptions about the likelihood of future events, and there can be no assurance that any design will succeed in achieving its stated goals under all potential future conditions. Over time, controls may become inadequate because of changes in conditions, or the degree of compliance with the policies or procedures may deteriorate. Other than the material weakness noted previously, there were no changes in the company's internal control over financial reporting during the fourth quarter of 2025 that were identified in connection with management's evaluation required by paragraph D of Rules 13A-15 and 15D-15 under the Securities Exchange Act of 1934, as amended, that have materially affected or are reasonably likely to materially affect the company's internal control over financial reporting. This annual report does not include an attestation report of the company's independent registered public accounting firm regarding internal control over financial reporting. Management's report was not subject to attestation by the company's registered public accounting firm, pursuant to rules of the Securities and Exchange Commission that permit the company to provide only management's report in this annual report. During the 3 months ended December 31st, 2025, none of our directors or officers, as defined in Rule 16A1F of the Exchange Act, adopted, modified, or terminated any contract, instruction, or written plan for the purchase or sale of our securities that was intended to satisfy the affirmative defense conditions of Rule 10b51c of the Exchange Act, or any non-Rule 10b51 trading arrangement as defined in Item 408C of Regulation SK. Spring Hollis, age 53, is the Chief Executive Officer and founder of Star Strong Capital, an investment firm that provides flexible capital solutions to lower middle market businesses, a position she's held since 2019. Before founding Star Strong Capital, Ms. Hollis was a managing director at Deutsche Bank, focused on principal investments in structured credit and esoteric assets from 2000 to 2010. Prior to her time at Deutsche Bank, beginning in 2000, her experience also included Park City's asset management as a specialty finance portfolio manager, and Briargate Capital as a founding partner focused on distressed issuers of privately held debt. Ms. Hollis also serves on the board of directors for the BOMA Project, an international nonprofit focused on the economic empowerment of women in sub-Saharan Africa. Ms. Hollis has a JD from New York University and a BA in philosophy from the University of Wisconsin-Madison. We believe Ms. Hollis's experience in banking and finance qualifies her to serve on our board of directors and in her capacity as an independent board member. Roger H.D. Lacey, age 75, has been a company director since 2008 and our chairman. Mr. Lacey served as CSI's Chief Executive Officer from February 2015 until November 30th, 2020, and served as the Executive Chairman of CSI's Board of Directors beginning in December 2018. He also assumed the additional role of Interim Chief Executive Officer of CSI on August 2nd, 2021 through March 28th, 2022. Mr. Lacey also served as Interim Chief Executive Officer of CSI from June 2014 until February 2015. Mr. Lacey was Senior Vice President of Strategy and Corporate Development at the 3M Company from 2009 to his retirement in 2013. He was the 3M Company's Chief Strategy Officer and Head of Global Mergers and Acquisitions from 2000 to 2013. Mr. Lacey's career with 3M began in 1975. From 1989 to 2000, he held various senior positions, including serving as Division Vice President of 3M Telecom Division. In addition, Mr. Lacey served as a member of the Corporate Venture Capital Board for internal and external new venture investments from 2009 to 2013. In addition, he is a board member of Johnsonville Sausage Corporation, a leading U.S. food company, and also a senior partner in CGMR Capital, a private equity firm, and board member of Cambeck, a leading manufacturer of specialty wood construction products, and board member of Halicon, an AI solutions company. He was formerly a member of the Board of Governors for Opus Business School, University of St. Thomas, a former visiting professor of strategy and corporate development, Huddersfield University, a founding member of the Innovation Lab at MIT, and is a former vice chair of Abbott Northwestern Hospital Foundation. We believe that Mr. Lacey is qualified to serve on our board of directors due to his unique perspective that combines familiarity with key technology markets around the world, combined with deep experience in strategic planning and business development. Scott Maskin, age 62, has served on our board of directors since November 2022 and is our interim CEO since May 2024. In December 2024, Mr. Maskin was appointed as the permanent CEO. Prior to May 2024, he was our Senior Vice President and General Manager, New York Division, from November 2022 to May 2024. Mr. Maskin is the co-founder of SUNation Energy and served as its Chief Executive Officer since its inception in June 2003 until the company's acquisition of SUNation in November 2022. Previously, Mr. Maskin developed nearly 20 years of experience on electrical and contracting work on commercial and residential properties and has a master electrician's license. We believe Mr. Maskin is qualified to serve on our board of directors due to his extensive experience and knowledge in the industry, particularly related to solar and battery energy storage systems for residential and small commercial customers. Kevin O'Connor, age 63, is the Long Island, New York president for Valley National Bank. He previously served as the Chief Executive Officer of Dime Community Bank, the successor organization to BNB Bank, after the merger between these two organizations in 2021. Dime Bank is one of the region's largest community banks with over 50 branches, 800 employees, and $12 billion in assets. Mr. O'Connor served as the Chief Executive Officer of the bank for 16 years, where he led the Long Island Community Institution through a period of dramatic growth and financial stability. Other roles in financial services included senior positions at North Fork Bank and KPMG. Mr. O'Connor has degrees in accounting from Adelphi University in 1984 and Suffolk Community College. We believe that Mr. O'Connor is qualified to serve on our board of directors due to his business and management experience and in his capacity as an independent board member. Our board is committed to sound and effective corporate governance practices. Our governance policies are consistent with applicable provisions of the rules of the SEC and the listing standards of the NASDAQ Capital Market, NASDAQ. We also periodically review our governance policies and practices in comparison to those suggested by authorities in corporate governance and the practices of other public companies. You can access the charter of our Audit and Finance Committee, the charter of our Compensation Committee, the charter of our Nominating and Corporate Governance Committee guidelines by following links on the Investor Relations Governance section of our website at ir.sunation.com. Our board of directors, as then constituted, held 15 formal meetings during 2025. The independent directors regularly hold executive sessions at meetings of our board of directors. During 2025, each of the directors then in office attended at least 75% of the aggregate of all meetings of the board of directors and all meetings of the committees of the board of directors on which such director then served. Each of our directors is expected to make a reasonable effort to attend our annual meetings of shareholders. Of our directors then in office, all directors attended the 2025 annual meeting of shareholders, which was held virtually. The company has 3 standing committees of the board of directors: the Audit and Finance Committee, the Compensation Committee, and the Nominating and Corporate Governance Committee. The members of the Audit and Finance Committee are Kevin O'Connor, Chair, and Spring Hollis. Our board of directors has determined that each member of the Audit and Finance Committee is independent under applicable SEC rules and NASDAQ listing standards. Our board of directors has determined that Mr. O'Connor is an audit committee financial expert as defined under the applicable rules of the SEC. Each of the members of our Audit and Finance Committee meets the requirements for financial literacy and possesses the financial qualifications required under applicable SEC rules and NASDAQ listing standards. The Audit and Finance Committee, as then constituted, met 4 times during 2025. The Audit and Finance Committee is responsible for the engagement, retention, and replacement of the independent registered public accounting firm, approval of transactions between the company and a director or executive officer unrelated to service as a director or officer, approval of non-audit services provided by our independent registered public accounting firm, oversight of our internal controls, and the receipt, retention, and treatment of complaints regarding accounting, internal controls, and auditing matters. Our independent registered public accounting firm reports directly to the Audit and Finance Committee. The Audit and Finance Committee operates under a written charter approved by the board, a copy of which is available in the Investor Relations Governance section of our website at ir.sunation.com. The Audit and Finance Committee has reviewed and discussed with management the company's audited financial statements for the year ended December 31, 2025. In addition, it has discussed with CBIZ CPAs PC, CBU, the matters required by the applicable requirements of the Public Company Accounting Oversight Board and the Commission. Also, the Audit and Finance Committee has received from CBIZ the written disclosures required by the Independent Standards Board Standard Number 1 and has discussed with CBIZ its independence from the company. Based upon this information and these materials, the Audit and Finance Committee recommends to the Board of Directors that the audited financial statements be included in the company's annual report on Form 10-K filed with the Securities and Exchange Commission. The members of the Compensation Committee are Spring Hollis, Chair, and Kevin O'Connor. Our Board of Directors has determined that each member of the Compensation Committee is independent under applicable SEC rules and NASDAQ listing standards. The Compensation Committee, as then constituted, met one time during 2025. The Compensation Committee is responsible for the overall compensation strategy and policies of the company, reviews and approves the compensation and other terms of employment of our Chief Executive Officer and other executive officers, oversees the establishment of performance goals and objectives for our executive officers, administers our incentive compensation plans, including the company's 2022 Equity Incentive Plan, considers the adoption of other or additional compensation plans, and provides oversight and final determinations with respect to our 401k plan, employee stock ownership plan, and other similar employee benefit plans. The Compensation Committee operates under a written charter approved by the board, a copy of which is available in the Investor Relations Governance section of our website at ir.sunnation.com. The members of the Nominating and Corporate Governance Committee are Spring Hollis, Chair, and Kevin O'Connor. Our Board of Directors has determined that each member of the Nominating and Corporate Governance Committee is independent under applicable SEC rules and NASDAQ listing standards. The Nominating and Corporate Governance Committee, as then constituted, met 3 times during 2025. The Nominating and Corporate Governance Committee is responsible for identifying, reviewing, and evaluating candidates to serve on the Board of Directors, evaluating our incumbent directors, recommending candidates to our board for election to the Board of Directors, making recommendations to the board regarding the membership of the committees of the board, assessing the performance of the board, reviewing succession planning of the Chief Executive Officer and other senior executives, and overseeing matters of corporate governance. The Nominating and Corporate Governance Committee operates under a written charter approved by the board, a copy of which is available in the Investor Relations Governance section of our website at ir.sunnation.com. When evaluating candidates for service as a director, the Nominating and Corporate Governance Committee and the board take into account many factors, including relevant experience, integrity, ability to make independent analytical inquiries, stock ownership, understanding of the company's business, relationships and associations related to the company's business, personal health, and a willingness to devote adequate time and effort to board responsibilities in the context of the needs of the board at that time. The board seeks individuals who reflect appropriate background, education, business experience, skills, business relationships and associations, and other factors that will contribute to the board's governance of the company. The board will consider candidates proposed by shareholders and evaluates them using the same criteria as for other candidates. A shareholder who wishes to recommend a director candidate for consideration by the committee should send the names and appropriate biographical information regarding the proposed candidates to the Nominating and Corporate Governance Committee at the company's principal executive office, 171 Remington Boulevard, Ronkonkoma, New York 11779. A shareholder who wishes to nominate an individual as a director for election, rather than recommend the individual to the board as a candidate, but does not intend to have the nominee included in our proxy materials, must comply with the advance notice requirements set forth in our bylaws. Mr. Lacey serves as our chairman of the board. The chairman of the board position is a non-executive position and is separate from the position of chief executive officer. Separating these positions allows our Chief Executive Officer to focus on our day-to-day business, while allowing the chairman of the board to lead our board in its fundamental role of providing advice to and independent oversight of management. Our board recognizes the time, effort, and energy that the chief executive officer is required to devote to his position in the current business environment, as well as the commitment required to serve as our chairman, particularly as the board's oversight responsibilities continue to grow. Our board believes that having separate positions, with a non-executive director serving as chairman, is the appropriate leadership structure for our company at this time and allows each of the positions to be carried out more effectively than if one person were tasked with both the day-to-day oversight of our business as well as leadership of our board. Information regarding executive officers set forth below is biographical and other information for our current executive officers, including their ages as of March 10, 2026. Information about Scott Maskin may be found above under the heading Information Regarding Directors. Mr. Brennan was appointed our Chief Financial Officer and Secretary in March 2025 and Chief Operating Officer in May 2024. He was the Senior Vice President, Corporate Development from November 2022 to May 2024. From March 2015 to November 2022, he was the Chief Growth Officer at SUNation Energy. Ms. Hlavka was appointed Chief Accounting Officer and Treasurer of SUNation Energy Inc. in April 2025. She was previously the Corporate Controller since March 2022. Previously, she served as Corporate Controller of Communication Systems Inc. from May 2011 to the merger. Ms. Hlavka also served as our Interim Chief Financial Officer from August 22, 2022 until October 10, 2022. From July 2008 to April 2011, she served as the Assistant Corporate Controller of Communication Systems Inc. Prior to July 2008, she was an auditor for Deloitte & Touche LLP. Delinquent Section 16A reports. Section 16A of the Exchange Act requires the company's officers and directors and persons who beneficially own more than 10% of a registered class of the company's equity securities to file reports of ownership and changes in ownership on Forms 3, 4, and 5 with the SEC. SEC regulations require us to identify anyone who filed a required report late during the most recent fiscal year. Based solely on a review of such reports and written information given to us by our directors and executive officers, we believe that all such required reports were filed on a timely basis under Section 16A for the fiscal year ended December 31, 2025. This section discusses our executive compensation objectives and policies, forms of compensation, and compensation related to services in 2025, paid to or earned by our named executive officers, the NEOs. The NEOs for 2025 were Scott Maskin, our Chief Executive Officer, James Brennan, our Chief Financial Officer and Chief Operating Officer, Andrew Childs, who served as Interim Chief Financial Officer until March 2025, and Kristen Hlavka, our Chief Accounting Officer. Compensation objectives and process. The Compensation Committee has designed the company's executive compensation program with a strategy to facilitate its ability to attract, retain, reward, and motivate a high-performing executive team. The company's compensation philosophy is based on a motivational plan to provide pay for performance at both the individual and company levels to enable the company's executive team to achieve the company's objectives successfully. Our compensation programs are designed to attract and retain individuals with superior ability and managerial experience, align executive officers' incentives with our corporate strategies, business objectives, and the long-term interests of our shareholders, and increase the incentive to achieve key strategic performance measures by linking incentive award opportunities to the achievement of performance objectives and by providing a portion of total compensation for executive officers in the form of ownership in the company. The Compensation Committee is primarily responsible for establishing and approving the compensation for all of our executive officers. The Compensation Committee oversees our compensation and benefit plans and policies, oversees and administers our equity incentive plans, and reviews and approves annually all compensation decisions relating to all of our executive officers, including our Chief Executive Officer. The Compensation Committee considers recommendations from our Chief Executive Officer regarding the compensation of our executive officers other than himself. Our Compensation Committee has the authority under its charter to engage the services of a consulting firm or other outside advisor to assist it in designing our compensation programs and in making compensation decisions. Compensation decisions for 2025. The Compensation Committee evaluates and establishes the goals, objectives, and substance of the company's executive compensation plans. The Compensation Committee has taken the following actions related to the components of executive compensation. On December 17, 2024, the company and Mr. Maskin entered into a written employment agreement for a 3-year term, which provides for an annual base salary of $295,000, and Mr. Maskin is eligible for the potential bonus in 2025 of up to 50% of his base salary, the latter of which is discretionary based on goals established by the company's board and may be changed from time to time. On December 9, 2024, the company entered into a written employment agreement with Mr. James Brennan as Chief Operating Officer and Chief Financial Officer for a 3-year term, which provides an annual salary of $275,000, and Mr. Brennan shall be eligible for the potential bonus in 2025 of up to 40% of his base salary, the latter of which is discretionary based on goals established by the company's board and may be changed from time to time. Ms. Hlavaca's annual base salary was established subsequent to the merger at $185,000. During the time in 2022 when Ms. Hlavaca served as our interim chief financial officer, her annual base salary was increased to $225,000 and then returned to $185,000 upon a new appointment of the company's chief financial officer, effective October 10, 2022, which compensation remained the same through 2024. On April 7, 2025, Ms. Helave Lifa was promoted to Chief Accounting Officer and Treasurer, and her annual base salary was increased to $200,000. Annual Cash Incentive Program. The Compensation Committee did not approve an annual cash incentive program in 2025. A key component of an executive officer's compensation is equity incentive awards, which are critical to focusing our executives on the company's long-term growth and creating shareholder value. In connection with the merger, the company's shareholders approved the Pineapple Holdings, Inc. 2022 Equity Incentive Plan, the 2022 Equity Incentive Plan, which became effective on March 28, 2022. On December 7, 2022, and again on July 19, 2024, the company's shareholders approved amendments to the 2022 Equity Incentive Plan that increased the number of shares of common stock authorized for issuance under the 2022 Equity Incentive Plan to 67 shares of common stock, 10 million prior to the reverse stock splits. During 2024 and 2025, the company effected 3 reverse stock splits, and the shares available in the 2022 Equity Incentive Plan proportionally decreased as a result. As a result, there were no longer enough available shares to do meaningful awards to employees, and the company did not grant any equity awards to named executive officers in 2024 or 2025. In addition to participating in company-wide plans providing health, dental, and life insurance on the same basis as all of our other employees, the NEOs receive other compensation and benefits in various forms, including an annual matching contribution of up to 50% of each executive's personal contribution to the company's 401k plan, up to the first 6% of the personal contribution. The amount of this other compensation for our NEOs is presented in the column titled All Other Compensation under the Summary Compensation Table and the All Other Compensation Table. On December 10, 2024, the Board of Directors of the company appointed its then interim Chief Executive Officer, Scott Maskin, as the permanent Chief Executive Officer, CEO of the company. In connection with his appointment as the permanent CEO, the company and Mr. Maskin entered into a written employment agreement, the CEO Employment Agreement, for a 3-year term, which provides for a base annual salary of $295,000, a base salary, and Mr. Maskin shall be eligible for the potential bonus of up to 50% of his base salary, the latter of which is discretionary based on goals established by the company's board and may be changed from time to time. In addition, Mr. Maskin is entitled to participate in all employee benefit plans or programs offered by the company to all its employees, subject to the eligibility requirements and terms of such plans or programs. Upon termination under the terms of the CEO Employment Agreement, Mr. Maskin shall be entitled to receive his base salary owed through the termination date, reimbursement of reasonable unpaid expenses incurred through such termination date. The CEO Employment Agreement also provides for certain payments and benefits in the event of a termination of his employment under specific circumstances. If, during the term of the CEO employment agreement, his employment is terminated by the company other than for cause, death or disability, or by Mr. Maskin for good reason, each as defined in his agreement, he would be entitled to I. Pay or provide the employee the benefits itemized in the CEO employment agreement, subject to his signing and not rescinding a release of claims in a form acceptable to the company, and he strictly complies with the terms of the agreement and any other written agreement between Mr. Maskin and the company or any of its affiliates as of the date any installments described therein is to be paid. The company shall pay to the CEO as severance pay a total amount equal to 100% of the annual base salary as of the date of termination. Pursuant to his employment agreement, Mr. Maskin has also agreed to customary restrictions with respect to the disclosure and use of the company's confidential information and has agreed that work product or inventions developed or conceived by him while employed with the company relating to its business is the company's property. In addition, during the term of his employment and for the 12-month period following his termination of employment for any reason, Mr. Maskin has agreed not to, among other provisions, 1. Perform services on behalf of a competing business, which was the same or similar to the type services he was authorized, conducted, offered, or provided to the company. 2. Solicit or induce any of the company's employees or independent contractors to terminate their employment with the company. Or 3. Solicit any actual or prospective customers with whom he had material contact on behalf of a competing business. On December 9, 2024, the company and Mr. James Brennan entered into a written employment agreement in connection with Mr. Brennan's employment as Chief Operating Officer, the COO Employment Agreement, for a 3-year term, which provides for a base annual salary of $275,000 base salary, and Mr. Brennan shall be eligible for the potential bonus of up to 40% of his base salary, the latter of which is discretionary based on goals established by the company's board and may be changed from time to time. In addition, Mr. Brennan is entitled to participate in all employee benefit plans or programs offered by the company to all its employees, subject to the eligibility requirements and terms of such plans or programs. Upon termination under the terms of the COO employment agreement, Mr. Brennan shall be entitled to receive his base salary owed through the termination date, reimbursement of reasonable unpaid expenses incurred through such termination date. The COO employment agreement also provides for certain payments and benefits in the event of a termination of his employment under specific circumstances. If, during the term of the COO employment agreement, his employment is terminated by the company other than for cause, death or disability, or by Mr. Brennan for good reason, each as defined in his agreement, he would be entitled to I. Pay or provide the employee the benefits itemized in the COO employment agreement, subject to his signing and not rescinding a release of claims in a form acceptable to the company, and he strictly complies with the terms of the agreement and any other written agreement between Mr. Brennan and the company or any of its affiliates as of the date any installments described therein is to be paid. The company shall pay to the COO as severance pay a total amount equal to 100% of the annual base salary as of the date of termination. Pursuant to his employment agreement, Mr. Brennan has also agreed to customary restrictions with respect to the disclosure and use of the company's confidential information and has agreed that work product or inventions developed or conceived by him while employed with the company relating to its business is the company's property. In addition, during the term of his employment, and for the 12-month period following his termination of employment for any reason, Mr. Brennan has agreed not to, among other provisions, 1. Perform services on behalf of a competing business which was the same or similar to the type services he was authorized, conducted, offered, or provided to the company. 2. Solicit or induce any of the company's employees or independent contractors to terminate their employment with the company. Or 3. Solicit any actual or prospective customers with whom he had material contact on behalf of a competing business. On January 1, 2025, the company and Ms. Kristen Hlavka entered into a written employment agreement in connection with Ms. Hlavka's employment, as amended on April 8, 2025, as Chief Accounting Officer and Treasurer, the CAO Employment Agreement, for a 2-year term, which provides for a base annual salary of $200,000 base salary. In addition, Ms. Hlavka is entitled to participate in all employee benefit plans or programs offered by the company to all its employees, subject to the eligibility requirements and terms of such plans or programs. Upon termination under the terms of the CAO employment agreement, Ms. Hlavka shall be entitled to receive her base salary owed through the termination date, reimbursement of reasonable unpaid expenses incurred through such termination date. The CAO employment agreement also provides for certain payments and benefits in the event of termination of her employment under specific circumstances. If, during the term of the CAO employment agreement, her employment is terminated by the company other than for cause, death, or disability, or by Ms. Hlavka for good reason, each as defined in her agreement, she would be entitled to I. Pay or provide the employee the benefits itemized in the CAO employment agreement, subject to his signing and not rescinding a release of claims in a form acceptable to the company, and he strictly complies with the terms of the agreement and any other written agreement between Ms. Hlavka and the company, or any of its affiliates, as of the date any installments described therein is to be paid. The company shall pay to the CAO as severance pay a total amount equal to 50% of the annual base salary as of the date of termination. Pursuant to her employment agreement, Ms. Hlavka has also agreed to customary restrictions with respect to the disclosure and use of the company's confidential information, and has agreed that work product or inventions developed or conceived by her while employed with the company relating to its business is the company's property. In addition, during the term of her employment and for the 12-month period following her termination of employment for any reason, Ms. Hlavka has agreed not to, among other provisions, 1. Perform services on behalf of a competing business which was the same or similar to the type services she was authorized, conducted, offered, or provided to the company. 2. Solicit or induce any of the company's employees or independent contractors to terminate their employment with the company. Or 3. Solicit any actual or prospective customers with whom she had material contact on behalf of a competing business. Under the 2022 Equity Incentive Plan and related award agreements, if a participant is terminated for cause or upon conduct that would constitute cause during any post-termination exercise period, all unexercised option awards and all unvested portions of any other outstanding awards will be immediately forfeited without consideration. If a participant's service is terminated due to his or her death or disability, I. All unvested restricted stock units shall vest as of the termination date. II. Unvested performance stock units will vest on a pro rata basis, based on the actual performance in the case of disability and the target performance in the case of death, and all wear, the currently vested and exercisable portions of option awards may be exercised for a period of 1 year after the date of such termination, and, upon termination for any reason other than death, disability, or cause, all unvested and unexercisable portions of any outstanding awards will be immediately forfeited without consideration, and the currently vested and exercisable portions of option awards may be exercised for a period of 3 months after the date of such termination. However, if a participant thereafter dies during such 3-month period, the vested and exercisable portions of the option awards may be exercised for a period of 1 year after the date of such termination. The 2022 Equity Incentive Plan and related award agreements provide that if either of the following occurs: 1. There is a change in control of our company that involves a corporate transaction. The outstanding awards are continued, assumed, or replaced by the surviving or successor entity, and within 24 months after the corporate transaction, a participant's employment or other service is involuntarily terminated without cause. Or 2. There is a change in control of our company that does not involve a corporate transaction, and within 24 months after the change in control, a participant's employment or other service is involuntarily terminated without cause. Then, each of the participants' outstanding options will become fully vested and exercisable, and will remain exercisable for 1 year, and each of the participants' unvested full value awards will fully vest. To the extent vesting of any award continued, assumed, or replaced is subject to satisfaction of specified performance goals, the number of units that would vest will be equal to A. if the accelerated vesting event occurs before the last day of the performance period, the target number of units, prorated based on the period of time during the performance period prior to the termination, or B, if the accelerated vesting event occurs on or after the last day of the performance period, the number of units will be determined based on the actual level of achievement of the performance goals. The 2022 Equity Incentive Plan and related award agreements also provide that if any outstanding award is not continued, assumed, or replaced in connection with a change in control involving a corporate transaction, then I, all outstanding options and SARs will become fully vested and exercisable for a period of time prior to the effective time of the corporate transaction and will then terminate at the effective time of the corporate transaction, and equal, all full value awards will fully vest. For these purposes, for a performance-based award, the number of units that would vest will be equal to A, if the accelerated vesting event occurs before the last day of the performance period, the target number of units, prorated based on the period of time during the performance period prior to the corporate transaction, or B, if the accelerated vesting event occurs on or after the last day of the performance period, the number of units will be determined based on the actual level of achievement of the performance goals set forth in the agreement. Alternatively, if outstanding awards are not continued, assumed, or replaced, the Compensation Committee may elect to cancel such awards at or immediately prior to the effective time of the corporate transaction in exchange for a payment with respect to each award in an amount equal to the excess, if any, between the fair market value of the consideration that would otherwise be received in the corporate transaction for the same number of shares over the aggregate exercise price, if any, for the shares subject to such award, or, if there is no excess, such award may be terminated without payment. For purposes of the 2022 Equity Incentive Plan, the following terms have the meanings indicated. A change in control generally refers to the acquisition by a person or group of beneficial ownership of more than 50% of the combined voting power of our voting securities, our continuing directors ceasing to constitute a majority of the board of directors, or the consummation of a corporate transaction as defined below. Unless immediately following such corporate transaction, all or substantially all of our previous holders of voting securities beneficially own more than 50% of the combined voting power of the resulting entity in substantially the same proportions. And a corporate transaction generally means I, a sale or other disposition of all or substantially all of our assets, or 2, a merger, consolidation, share exchange, or similar transaction involving us, regardless of whether we are the surviving entity. Incentive Compensation Recovery Policy. The board has adopted a compensation recovery policy, the clawback policy, effective October 2, 2023, in compliance with the listing standards of NASDAQ. The clawback policy provides that promptly following an accounting restatement due to the material noncompliance of the company with any financial reporting requirement under the securities laws, including any required accounting restatement to correct an error in previously issued financial statements that is material to the previously issued financial statements, or that would result in a material misstatement if the error were corrected in the current period or left uncorrected in the current period. The Compensation Committee will determine the amount of the excess of the amount of incentive-based compensation received by Section 16 officers during the 3 completed fiscal years immediately preceding the required restatement date over the amount of incentive-based compensation that otherwise would have been received had it been determined based on the restated amounts. The company will provide each such officer with a written notice of such amount and a demand for repayment or return. If such repayment or return is not made within a reasonable time, the clawback policy provides that the company will recover the erroneously awarded compensation in a reasonable and prompt manner, using any lawful method, subject to limited exceptions as permitted by NASDAQ listing standards. Relationship between pay and performance. Our executive compensation program seeks to align executive officers' long-term interests with those of our shareholders to incentivize a long-term increase in shareholder value, and therefore does not specifically align the company's performance measures with compensation actually paid, as defined by SEC rules for a particular year. In accordance with Item 402V of Regulation S-K, we are providing the following graphic descriptions of the relationships between information presented in the pay versus performance table above for each the 3 years ended December 31, 2025. The following graphs address the relationship between compensation actually paid, as disclosed in the Pay versus Performance table for our PEOs, and the average amounts for the non-PEO NEOs, and 1. The company's cumulative TSR, and 2. The company's net income loss. In 2025, the annual compensation payable to non-employee directors of the board, payable on a quarterly basis on the first day or as soon as practicable after the first day of each quarter. $30,000 cash retainer for all non-employee directors, $7,500 additional cash retainer to each chair of a committee of the board, $5,000 additional cash retainer for service on each committee of the board, excluding the chair of such committee, and $15,000 additional cash retainer to the chair of the board. While non-employee directors received an annual grant of RSUs in 2022, the RSU grant initially intended for 2023 was not made until early 2024. As a result, our non-employee directors did not receive any equity awards in 2023. During 2024 and 2025, the company effected 3 reverse stock splits, and the shares available in the 2022 Equity Incentive Plan proportionally decreased as a result. As a result, there were no longer enough available shares to do meaningful equity awards, and the company did not grant any equity awards to directors in 2024 and 2025. Beneficial ownership is determined in accordance with SEC rules. These rules generally attribute beneficial ownership of securities to persons who possess sole or shared voting power or investment power with respect to those securities, and include shares of common stock issuable upon the exercise of options, warrants, preferred stock, and other securities that are immediately exercisable or convertible within 60 days of March 10, 2026. Except as otherwise indicated, all persons listed below have sole voting and investment power with respect to the shares beneficially owned by them, subject to applicable community property laws. The information is not necessarily indicative of beneficial ownership for any other purpose. SUNation acquisition. On November 9, 2022, the company acquired all of the issued and outstanding equity of SUNation Solar Systems, Inc., and 5 of its affiliated entities, SUNation, directly or indirectly from SUNation's owners, which included Scott Maskin and James Brennan, with the other 2 owners, Scott Sousa and Brian Karp, collectively the sellers. Mr. Maskin was appointed a director of the company and the senior vice president and general manager, New York division, of the company, received 3 shares, 513,300 shares prior to the reverse stock splits of company common stock as consideration in the transaction, and was granted an inducement award of 1 restricted stock unit, 69,091 restricted stock units prior to the reverse stock splits in connection with his employment with the company. Mr. Brennan was appointed Senior Vice President, Corporate Development of the company, received 3 shares, 494,007 shares prior to the reverse stock splits of company common stock as consideration in the transaction, and was granted an inducement award of 3 restricted stock units, 455 restricted stock units prior to the reverse stock splits in connection with his employment with the company. The terms of Mr. Maskin's and Mr. Maskin and Mr. Sarah Brennan's current employment agreements are set forth above under Employment Agreements. The company acquired SUNation from the sellers for an aggregate purchase price of $18,440,533, comprised of A. $2,390,000 in cash consideration paid at closing, B. The issuance at closing of a $5 million short-term limited recourse secured promissory note payable to Messrs. Maskin and Brennan, the short-term note, C. The issuance at closing of a $5,486,000 long-term promissory note payable to Messrs. Maskin and Brennan, the long-term note, with a fair value of $4,830,533 at the acquisition date, and D. The issuance at closing of an aggregate of 1,480,000 shares of company common stock. The purchase price also includes potential earn-out payments of up to $5 million in the aggregate based on the percentage of year-over-year EBITDA growth of the SUNation businesses in 2023 and 2024. The short-term note was paid in full on June 1, 2023. The long-term note was unsecured and initially matured on November 9, 2025. On April 10, 2025, the original long-term note was amended and restated as follows. the principal amount of $5,486,000 previously due and payable under the original long-term note, together with all accrued and unpaid interest owing thereunder, shall be due and payable on May 1st, 2028, the maturity date, and such amended note shall become a senior secured instrument. Principal and interest payments under the amended long-term note shall be payable monthly on the first day of each month, commencing with June 1st, 2025, for 36 consecutive months thereafter, pursuant to the terms thereunder. Additionally, pursuant to the terms of that certain senior secured contingent note instrument entered into on April 10th, 2025, the unearned 2024 earnout was rescheduled and shall be based on the earnout terms set forth therein pursuant to the financial conditions and terms covering each of fiscal years 2024 and 2025, and if attained, shall be payable over a period of 24 months beginning in fiscal year 2026, which payment is further conditioned on the continued employment of the note holders at the time of such earnout payment trigger date. The company's board has adopted governance guidelines that include provisions with respect to conflicts of interest. These guidelines describe a conflict of interest as a situation in which a director's personal interest, including an immediate family member interest, is adverse to or may appear to be adverse to the interests of the company. The guidelines provide that any situation that involves or may reasonably be expected to involve a conflict of interest with the company must be disclosed promptly to the chief executive officer, the chairman, and the company's primary legal counsel. If the company wishes to proceed with a transaction involving a potential conflict of interest, the board would intend to seek prior approval from the Audit and Finance Committee to ensure the transaction is beneficial to the company and the terms of the transaction are fair to the company. On July 18, 2025, the Audit and Finance Committee of the Board of Directors, the Audit Committee of the company, dismissed UHY LLP, UHY, as the company's independent registered public accounting firm. During the company's two most recent fiscal years ended December 31st, 2023 and December 31st, 2024, and during the subsequent interim period from January 1st, 2025 through July 15th, 2025, there were no disagreements with UHY on any matter of accounting principles or practices, financial statement disclosure or auditing scope or procedures that, if not resolved to UHY's satisfaction, would have caused UHY to make reference to the subject matter of the disagreement in connection with its reports. And there were no reportable events as defined in Item 304AW1 of Regulation SK. The audit reports of UHY on the consolidated financial statements of the company for each of the two most recent fiscal years ended December 31, 2023 and December 31, 2024 did not contain an adverse opinion or a disclaimer of opinion and were not qualified or modified as to uncertainty, audit scope, or accounting principles. On July 18, 2025, the Audit Committee approved the engagement of CBIZ CPAs PC, CBIZ as its new independent registered public accounting firm. CBIZ's appointment is for the company's fiscal year ending December 31, 2025, and related interim periods. During the company's two most recent fiscal years ended December 31, 2024, and December 31, 2023, and for the subsequent interim period through July 15, 2025, neither the company nor anyone on its behalf consulted CBIZ regarding the application of accounting principles to a specified transaction, either completed or proposed, or the type of audit opinion that might be rendered on the consolidated financial statements of the company, in connection with which neither a written report nor oral advice was provided to the company, that CB's concluded was an important factor considered by the company in reaching a decision as to the accounting, auditing, or financial reporting issue, or, unnoted, any matter that was either the subject of a disagreement as defined in Item 304A1_1_E of Regulation SK or a reportable event as described in Item 304A1_V of Regulation SK.